did just fine with rates at this level. So it's not so much the level of the rates that's the problem, it's the adjustment. You know, we thought we had gone through that adjustment last year and that was rather painful. We're getting a mini replay of that now. But once we do get to what we hope to be relatively stable and a point for rates that they can start to move down, then I think the economy will be able to withstand it.
When you point to that era where the economy did just fine, it was also at a time where this was actually the rate being borrowed at. Right now, it is not for the vast majority of consumers and for the vast majority of corporations. In the U.S., they are not paying those rates. So have we really felt the effects of the monetary policy tightening that everyone talks about with shock, or is it a long way away?
Well, definitely have not felt the impact, and that's the whole, I mean, fundamentally the challenge for the Fed is to assess when is it going to come, how long is it going to take. But if you look at, I think, you know, corporations by and large, you know, they were smart enough to take advantage of rates when they were very low. They've, you know, absolutely termed out a lot of their debt. You kind of consequently don't have the sensitivity to the moves in rates that maybe you had historically, which goes back to your point about resilience. So it'll happen, but I think it'll happen slowly enough that we don't see that in and of itself as a major risk.
Do you think that the levels that we're seeing now, specifically in long-term yields, are the new levels that we're going to see for the foreseeable future?
Well, probably not at quite this high, but something with a four handle I think makes complete sense. I mean, just a rough rule of thumb, if U.S. trend GDP growth is 1.75 or so real and inflation's 2 or more, you know, it's a 4%. And I think, especially what happened post the Fitch downgrade, I think it's levels now that seem much more sensical, if you will, than necessarily what we had when we were sub 4.
Do you sense this FOMC is confused?
I don't know if I'd use the word confused. Why do you say that?
Did you get a satisfactory explanation of what they're forecasting?
Well, you know, if you always want to find a perfectly coherent and believable story between the dot plot and between what you get with the summary of economic projections, you could have a lot of fun. I don't know how successful you would be.
They seem somewhat mystified by how resilient this economy has been. Steve Englander of Standard Chartered has written about that in the last couple of days. They seem somewhat mystified about it. I think if you'd asked any of us 12 months ago what 5% interest rates would do to the US economy, we wouldn't have unemployment with a 3-handle and jobless claims down at 201,000, would we?
Well, I think that mysticism's pretty widely shared, if we're all honest, and it's justifiable insofar as we have never ever had this scenario that we've had over the last 3 years between the pandemic and the stimulus.
So why is it the consensus view, Dan, that we are sufficiently restrictive when we're also mystified by how the economy is responding to interest rates?
I think it's more the response to what we now, you know, if rates are at a sufficiently or at a restrictive level now, I mean, it's still the basic principles of economics are still going to hold in terms that that's going to slow down growth. It's just how quickly, that's where I think we've been much more challenged in assessing, understandably. I don't think it's a criticism of the Fed.
So BNP Paribas has been so good about nominal GDP guesstimates, about taking a real GDP and overlaying some form of inflation number on it. Do you frame the United States as a sub 4% nominal GDP?
Well, yeah, conceivably. I mean, we have to go back to, you know, has the long-run trend growth rate of the U.S. changed in some kind of fundamental way, you know, post-global financial crisis, post the pandemic? And, you know, we still go back to, and we don't want to forget the longer-term trend issues that the U.S. faces, you know, demographics and so on. But if there's an argument for that growth rate to be higher now, frankly, it does come back to AI. I mean, if the kind of fundamental key challenge that the U.S. faces, Europe faces, Japan faces, it's lack of labor, you know, and if this is a way to increase productivity and at least lessen that constraint, that actually is the one thing that maybe gets you above a 4% nominal.
I look at this as just the arch issue. Greg Bowdle is more enthusiastic about equities, U.S. equities as well. Do you share his enthusiasm?
We're more cautious, actually, and it's as much an assessment of, you know, how adept is the Fed going to be at knowing when to cut rates? I mean, if we go back to, you know, as we've discussed for 9 months now, about inverted yield curve saying a recession is going to come. Well, if that's, I think, fundamentally because the central banks in general have made a mistake and held rates too high for too long, that certainly can happen again. So I think our concern is that they are going to keep rates too high for too long. They're going to slow down growth too much. That's going to hit corporate profits, and the consensus estimates that we see for earnings estimates aren't going to materialize.
So the median projection of the Federal Reserve, if we were to ascribe a narrative, forgive me because I'm going to, they're essentially telling us right now that we can get back to 2% and unemployment
with
goes
no slowdown,
no higher than a little above 4%.
Yeah, we're not quite that optimistic. No, nice story.
BNP Paribas. It is a nice story, isn't it? It's a story that they're not really telling, though, Lisa. They're just sort of projecting it without.
It's not their baseline, but it is their baseline.
Well, can you make sense of that? It's an objective, not the baseline. So our projections aren't forecasts, they're aspirations?
It was not a coherent, total message. I think that we can all agree on that. The key question to me is, where are they wrong? Is it how much inflation is going to come down, or is it how much unemployment is going to go up? Is it the weakness, or is it the strength? Right. And a lot of people in the market seem to be saying it's the strength, which is the reason why yields on the long end are the ones that are rising so much more. There's a question of that, whether that's getting embedded in market expectations as they push against the
I think Arthur Burns in another time and place had aspirational smoke signals coming out of his pipe. There's just way too much information now, and all of it is predicated on guessing and forecasting. They're data dependent, and by definition, as Daniel correctly states, they're going to be exports.
You want less information?
I would like them to be more choosy, more surgical about the too much information they have now. Instead of, do we have 3 Fed speakers today?
I think we do, yeah.
I think it's
Why not a 4th?
Look, I've said over the last couple of days, it's right to convey the appropriate dose of uncertainty that surrounds any forecast, and the chairman did a great job of that. I do think we need a sophisticated conversation about the underlying dynamics by which they're confused. And at the moment, it seems they are confused by how well this labour market has stood up to the interest rate increases they have done, which makes me wonder why we have any degree of confidence whatsoever about being sufficiently restrictive.
Correct.
That's a conversation we have to have with yields where they are right now at 450 on a 10-year and a 2-year pushing 520. If you are just tuning in, welcome to the programme. Equity futures right now just about positive by 0.16%. Coming up in the next hour, Sarah Malik of Nuveen, tons to talk about. I think we should wrap up the calls of the week so far as well here in London. And Rita Sen with that call on triple-digit crude by Halloween. Maybe that's the story just around the corner. Max Kettner of HSBC, given everything that's taking place right now, still super constructive, still saying we need to focus on what can go right next year. But Lisa, when you see moves like this in the bond market, sometimes you just can't help but think, what could go wrong?
That's the reason why you're seeing people sell tech, which is the one thing that really did well. I mean, let's be honest, that's really what has been the gains in the U.S. equity market. It's almost entirely been the Magnificent Seven. You strip those out, you're up less than 2% on the year for the rest of the
I'm going to go to the trading envelope function on the Bloomberg. I'm going to look at standard deviation moves, and we're all addicted to normalcy and up, up, up. And the answer is you're allowed to correct 10%. We're nowhere near that in many, many series. We have not seen any pain. OMG, what was it yesterday, John? The VIX went 14 to 17, down 3%, whatever it was. That's another day at the races and another time and
We had a 1.6% move. We just haven't had a move like that for 6 months.
Dow Jones Industrial Average like rocks.
It's been fairly snoozy, even with a banking crisis, although Mohammed said don't call it a banking crisis.
He was right.
We moved on, didn't we? Let's see if it comes back. AMH in New York, up next from London. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
as I discussed with President Zelensky, the people of Ukraine are steeled for this struggle ahead, and the United States is going to continue to stand with you. Today, I approved the next tranche of U.S. security assistance to Ukraine, including more artillery, more ammunition, more anti-tank weapons, and next week, the first U.S. Abrams tanks will be delivered to Ukraine.
The President of the United States, Joe Biden, speaking in a meeting with Ukraine's Zelensky. Anne-Marie from New York on the UN General Assembly in just a couple of moments. Let's get you up to speed on the price action. Equities trying to bounce positive by 0.2% on the S&P yesterday. Biggest one-day loss going all the way back to March. Remember the banking issues? Moved on from that pretty quickly. If I told you back in early March, though, that cycle highs on bond yields were in our future, I'm not sure what you have said back to me. 520, got close to it in the last couple of days on a 2-year, 450. We had a little look at it in today's session on a 10-year, 448.64, Lisa. Yields almost unchanged on the day, but what a move it's been over the last couple of days. Ben
Carlson, out on X, pointed out that the pandemic lows for treasuries, not just give you two denominations, 2-year, 0.09%, 10-year, 0.5%, now 5.14%, 4.447. He says, it's kind of crazy nothing is broken yet. I think we all can agree. When does something break, or does it not break because this is the new normal?
Well, I did say, and Lisa, I know you're on the same page with this, something did break back in spring. The banking system started to break, didn't it?
Which then was quickly remedied. So this raises a question, would we have felt the effects if policymakers hadn't stepped in to ease the frictions, the fissures that happened during some of the banking crisis that wasn't?
I always go back to that Torsten Slok deck over at Apollo, and he's got the delinquencies, he's got bank lending, all of that stuff in there. I was going to say all that good stuff in there, but it's bad stuff right now. So you are seeing that tightening start to come through. You're certainly not seeing it in a profound way in the mortgage market or housing in America, and we can talk more about that. But these are reasons why the likes of Andrew Hoddenhorst, the City, thinks that maybe you see more price pressure, that the labour market does matter, that the housing market does matter, and that could contribute to a re-acceleration of inflation. That's why I think this Federal Reserve has so much uncertainty about the future, because there is that risk that those things materialise, and they don't want to entertain any kind of conversation about rate cuts anytime soon with that in mind.
At the same time, there isn't a lot of discussion about going much further and raising rates much further. There's sort of a tacit understanding that they've gone as far as they can go. And Jim Bullard was saying he doesn't believe in lag and lag effects, long and lag effects. If he doesn't believe in that, well then you would have to assume that rates should be higher if we have unemployment rates so low and jobless rates coming in even lower than people expect.
I'm so glad you brought that up. That was an incredibly important statement by Dr. Bullard. The idea here of taking a model from the 50s and 60s from a goods and services America that was totally different, John, and bringing that monetary timeline out to the modern age, and he would say we transmit rapidly faster.
Credit to Bill Dudley, former New York Fed president, for writing that column in the summer. I think about a month before Jackson Hole, he was raising that question whether we'd already seen all the policy come through already. We've lived with it, we're down with it.
We're going to do the shutdown now, but before that, we need to look at something really shocking. Our Margaret Collins in Washington reports in conversation with Mr. Zelensky that there may be a winter war in Ukraine. That's an assumption not made. Anne-Marie Horton is very familiar with this, particularly with continental European seasonality and war. Anne-Marie, I was shocked by Peggy Collins' story, the idea of autumn, okay, I'll take it. But we're going to have a winter war in Ukraine?
Well, I think what you see from Volodymyr Zelensky, who was in Washington, D.C. yesterday, was that he wants to make the point very clear to not just American lawmakers, but the American electorate, that they are not going to stop in this counter-offensive, and they want to continue to try to retake these cities, regardless of how difficult it may be with the harsh winter that you see, especially in eastern Ukraine. Peggy Collins, our bureau chief in Washington, D.C., was a part of a group of reporters that got to speak to him. I was more taken with, and I know they were pressing him about what was the conversation between you and Speaker McCarthy. And the quote was, in their private meeting Thursday, House Speaker Kevin McCarthy, quote, said that they will be on our side, according to President Zelensky when he sat down with these reporters last night.
AMH, we said it earlier this week, this is a wartime leader in Ukraine, and I think we have to say that up front. Just purely from an observational standpoint, not a judgment, do you sense a degree of frustration with the leadership of Zelensky within certain nations in Europe and across Washington, D.C., beyond the obvious places?
I would say this goes beyond even Europe and Washington, D.C. I would say that anyone who has been giving this individual help in the meetings he has had, there is a little bit of frustration for potentially how much the Ukrainians ask, and also the fact that these leaders are dealing with an electorate that is growing uneasy. There is a sense of war fatigue that they are all dealing with. Many are also dealing with upcoming elections. So this is a difficult one for Zelensky and a difficult line for him to walk, especially as we do know what President Vladimir Putin wants to do. Putin wants to keep this going at least until the U.S. election of November of next year. So Zelensky knows that he needs to keep the pressure up when it comes to the aid that he's asking for. But when you're not making a tremendous amount of progress in terms of the counteroffensive, the messaging becomes very difficult.
And Maria, how much is aid to Ukraine part of the whole debate that's factoring into the potential shutdown in Washington, D.C.?
It's factoring in a lot, because I would say that yesterday, one of the key things to watch out for, and we talked about it yesterday morning, was that vote at 10:30 a.m. And this was just a vote, a rule, to then allow the defense bill on the floor to debate it. And our Kayleigh Lyons spoke to Marjorie Taylor Greene, who voted no against that. And she had said that this was because of Ukraine aid. I'm trying to find the quote now. She said it was because of Ukraine aid. And she says, if you take the Ukraine aid out, I would be okay with even debating that defense bill. And I say this is important. It's not in the continuing resolution, but that vote was going to show how united McCarthy's party and his caucus is when it comes to keeping them together. But they couldn't even get a bill on the floor to debate. So you could see how far apart the centrists are in his conference and some of these hard right members in his conference. And Ukraine aid is one of those really big sticking points.
Emery, do you expect there to be some sort of vote of confidence with Kevin McCarthy? Is he at risk of losing his House Speaker role?
Potentially. You know, you have the likes of Matt Gaetz, the representative from Florida, who says he wants to begin every day with the prayer, the Pledge of Allegiance, and a motion to vacate, wants to get rid of Speaker McCarthy. This will become a little bit more clear whether or not we will see it, depending on how the continuing resolution plays out. Likely there'll be a government shutdown. Likely you'll have to pass a clean CR, and then that would be a moment that potentially you see some individuals on the hard right say, you have not delivered for us, so we do not want you as our speaker.
Okay, that's an important distinction, Amory. We feel sort of out of the loop here in London. Let's cut to the chase. You're stating that you frame a shutdown as a likely occurrence now?
Yes, Speaker McCarthy has sent lawmakers home. They are not even in D.C. to vote. They can be called back, but some of them have left. So they are home now until next week. The government runs out of funding September 30th.
Amazing. MH, thank you. Anne-Marie over in New York for the UN General Assembly. I've got no idea.
He loves talking about this.
For those just tuning in.
That's sarcasm.
I really don't, for whatever that's worth, all right? I really don't.
I'm right there with you.
It drives me nuts. I think it drives everyone crazy. Maybe this is the real deal. Maybe we do shut down, put that together with a strike at UAW. Maybe you do slam the brakes on a little bit of a solid, resilient U.S. economy.
I want to make clear, particularly to our international audience, you know, I grew up in a house where there was hysterics about the debt and the deficit. That goes back to Hal Bronner and Bernstein's classic book. And John, a shutdown is not the same as an argument about the debt or the deficit and OMG, trillions of dollars, we're all going to die. A shutdown affects people who don't have the luxury of going to a font of savings to get through whatever. Millions of people, and some in, you know, medical and
certain people in certain roles that will be going to work and not getting paid some.
I just want to partition this from the fiscal follies over to a shutdown, which is absurd.
I hear you.
It's absurd.
Let me get you the next 35 minutes or so set up. This is what the schedule looks like. George Saravelos of Deutsche Bank on foreign exchange is going to be joining us shortly. Dollar stronger again this week against the euro. 10 weeks of it. Lots to talk about there. Interest rate policy, the difference between growth in Europe, not much of it, growth in America, pretty solid. And then we'll catch up with Roger Boodle, the Capital Economics founder, good friend of this program, Tom, over the years. I know you're looking forward to that one. That's in the back half of this hour.
Boodle on the follies of London. There's a little bit going on. I think he drives an EV.
There's a lot going on. We can talk about that with him, actually. Equities on the S&P 500 trying to bounce from London. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
Potentially the worst week since March, heading towards a third week of losses on the S&P 500.
Closer to Bramall
Equity
than me.
futures up, a lift here by 0.2% on the S&P. What are you two talking about? On the Nasdaq, up by 0.4% on the Nasdaq 100. Futures doing a little bit better. Do you want to settle the argument now or on the next board?
No, it's good.
Honestly, can I just say this?
Sure.
Just because the market is down doesn't mean that someone who's saying that it is down is gloomy. They're just reporting the facts. And so good job reporting the facts and putting it into perspective.
Okay.
Fortunately, we all fly on different airplanes.
We're bouncing now. Okay, anyway, you two carry on argument. Let's turn to the bond market. 2-year, pushing 520 a little bit earlier this week. A 10-year in Asian trading, pushing 450, went through it briefly, coming back by a basis point. These are yields we haven't seen since 2007 on a 10-year. It's amazing to see a 30-year yield now looking at, what, 460 maybe? 456.39. Big moves this week, cycle highs on bond yields, resilience in the US economy, no resilience at all in Europe. Let's turn to the euro. The euro negative against the US dollar for 10 consecutive weeks. The euro right now 106.39, down by 0.2% on that currency pair. Tom, the data out of Europe, I've used that word dreadful too many times. Ugly, brutal, just not nice. Sub 50, contraction, France. Not much better.
Different shades here, and maybe there's all different stories to it, but the answer is they don't have the dynamism of the United States. It's going to be, where are they in November? Where are they as they drift into winter? And particularly if oil prices stay sustained. We haven't even touched on gas, natural gas.
Well, this is what we were talking about with Jordan Rochester, right?
Yeah.
Namora, you get the pickup in gas prices. That's the toxic brew, Bramo. Toxic.
There are a couple of them.
Under surveillance this morning, 3 holds across the board for major central banks this week. The BOJ joining the BOE and the Federal Reserve, leaving rates unchanged. Governor Ueda tamping down speculation of a future rate hike, saying this, because we aren't in a state where inflation accompanied by wage growth, sustainable and stable inflation, is in sight. We're patiently continuing with monetary easing under the current framework. The BOJ, I thought he made some comments recently that if wage growth remains buoyant into year end, they'll have a little look at moving away from negative rates. What happened to that?
I don't know. JP Morgan thought that maybe by the end of the year they could abandon negative rates, and by next year they could abandon yield curve control. Pushes back against that, even after getting a hotter than expected CPI print in Japan.
North of 3.
Yeah. How much are they getting cover from the fact that he doesn't have to say anything and people are just quavering under the fear of some sort of foreign exchange interventions? They're not going to even bother.
Like us, they have different inflation metrics, including fresh fruit, and there's 40 other ways to slice it, including a Tokyo CPI as well. But the answer is, when we say 3 or 4% inflation there, it's not the same as 3 or 4% inflation in America or the continent of Europe. That is a whole new world, after all, for the people of Japan. That is high inflation.
Yeah, when you've been living with 0,
yeah,
no inflation, you get 3.
I think that's behaviorally and politically, that's the
So we said that's like 6?
I haven't done the work. I don't know, but yeah, you can make that study. You can do it on the Bloomberg if you do a double chart overlay with 2 y-axes.
Nice. You should do that, TK.
My free time.
Let's get you your update on the big three automakers bracing for more walkouts potentially today as they remain far apart from the UAW on key issues, including job security and pay parity for temporary workers. Union President Sean Fain expected to make an announcement, as Tom just mentioned, through Facebook Live at 10 a.m. Eastern Time. We've got a deadline, Tom. It's midday. And ultimately, the deadline apparently with UAW is never midday. It's 2 hours before.
Exactly.
So there was a midnight deadline and there was a 10 p.m. news conference. So basically, if you don't have your stuff together, almost said something else then, by midday, he'll do a news conference at 10. Restraint. They'll do a news conference at 10.
Keep it together, John. That's okay.
Maybe make this strike a little bit deeper.
Where are the automakers? Am I surprised that I haven't heard massaged statements from various automakers?
Well, you have. They've talked about how it's unaffordable, and the 36% wage increase that you are asking for, that they're asking for, is not affordable. What I find interesting is it's not about the salary. It's not about the take-home money. And this, according to one union member, it's about job security and product. We need to keep jobs in this country. They're taking billions in tax incentives, EVs, but when it comes to keeping jobs here, they won't guarantee anything. And that is ultimately at the crux of the debate.
Job guarantees, the stakes are higher, big EV transition is not going to be straightforward. We're learning that in the UK. It's going to be difficult in the United States as well. I want to finish on this story. Apple's newest iPhones and watches went on sale in about 40 countries today, including Australia, China, the US, and the UK. Sold out pre-orders and long lines. Long lines, we're still doing long lines outside retail stores, indicate strong initial demand. Bramo is going to get a new iPhone 15.
Only because I cracked my existing phone. That's the only reason why. Yeah, but I'm not going to be waiting in line. I don't understand lines.
Why are they still doing that?
Because it generates excitement. Demand, you're going to be in on it.
Apple, but like, why do you want to do it as a consumer? You can go and just, get it from...
You go hang out. You're the first adopter.
That's
you
still
can
a
go to
thing.
your friends and you can be like, look at all these cool gadgets.
Is that still cool?
I don't know. Am I cool? I don't think so.
Pretty sad,
I don't think
isn't
that
it?
I could do that.
Line up when you don't need to.
But except if you're with your friends and you're talking and there's the excitement around it and it gives you something to do. I don't know. I'm making a pitch.
Do you want to go to Covent Garden today?
Actually, I've been in that store now that you mentioned it. And the answer is, no, I'm just taking it in because I think what Dan Ives would say is a bull on Apple is it's not an $1,100 or $1,300 or with 1 terabyte, $1,600 transaction because you're slipping into it for $46.32 a month off some stupid plan at a company. I really take issue with the snobism and bad research of a lump sum purchase. It ain't happening.
I didn't do it either. I don't think you did either. You do them.
I'm not buying the new one. I still owe money on this one. I called him up and I said, I didn't even know where I bought it. I'd forgotten where I bought it.
This is paid. We're done and dusted. Those monthly payments
well,
are
then
done,
you can slip into it like Bramo.
Nope.
You can slip into a new one.
Upgrading until they ruin it.
George is about ready to walk out of the room. Should we get to our guest?
I think you probably should, yeah.
Let's get to our guest. Joining us, and this is really, really important, folks. This is what surveillance is about. Joining us is George Seravolis, Global Head of Foreign Exchange Research. And as we had Jordan Rochester with us a bit back, you take a starkly different view. I want to set this up with selected firms saying Swiss franc dominant, lots of financial tension. Swiss franc will do better, others will do weaker. You go the other way. Why will Swiss franc weaken and other currencies will prosper in this time?
So thank you for having me. We did just publish our outlook for the end of the year, and we've been very bullish on the Swiss franc for more than a year, actually, but this is the first time where we switched. And there's a couple of reasons. The first one is, and the most important, is the central bank. They came out yesterday and they've said inflation is now below target. They don't need to hike rates now, and they think they're done. And the fundamental reason behind why the Swiss franc has been so strong is because of the central bank that's been supporting it. So it's starting to look more attractive as a funder, it's looking expensive, and that's why we changed the view.
In the last 72 hours, and go with the real yield in America, but many other indicators, John's been great about framing out what gilts have done, what Germany's done, Bunds, what we've seen in the United States of higher yields. Is that, as a general statement, the ultimate fake-out rally in yields setting us up for a general global disinflationary trend?
Well, I think this has been the big question throughout the year. Are you going to get a hard landing? When especially does the US slow? Everyone's been focused on this US recession. So the key question we need to ask ourselves is, why isn't it happening? And there's theories around exceptionalism, AI, but if you look at the data, the simple reason is the Fed rate hikes are not being passed through. So, for example, corporate interest payments are actually going down, and that's because everyone's on very fixed term borrowing in the housing sector. You're in fixed mortgages. So the slowdown will eventually mathematically come, but it's just taking a very, very long time.
Are you seeing a cleaner, quicker transmission of monetary policy in Europe?
Absolutely, and I think that's the key difference if you look globally. So let me give you an example. If you look at average mortgage rates in the US, they're up by 20 basis points since the rate cycle started. If you look at Sweden, they're up 200 basis points. We're talking about a magnitude 10 times as different. So what's going on in markets is quite different to what's going on in the real economy. And I think this key question of transmission is what's affected this currency divergence, so to speak, and will matter a lot going forward as well.
I'll tell you what I see, and then there's a question involved in it. My observation is it's quicker and cleaner. It's hitting growth. It's not bringing down inflation. So can you help me understand why it's not bringing down inflation? Because it's meant to go as follows. Comes out of the central bank, hits growth, inflation falls. That's not happening in Europe. Why not?
So it's interesting you mentioned inflation. What I would say in the US is while growth is surprised to the top side, inflation is actually being surprising to the downside. So everyone's growth numbers are being constantly revised higher, but they're moving down inflation. So in the US, inflation is actually doing even better in terms of deceleration, and that's because the supply side is improving. In Europe, there's a bit of a lag, but if you look at the month-on-month numbers, so in the US, everyone reports inflation numbers in month-on-month terms.
Sure.
In Europe, we never get to see that. Month-on-month inflation in Europe's also slowed down. It's 0.2, 0.3 the last few months, if you adjust for all the distortion. So it is coming down. I'd say that's one reason why we've got the ECB topping out, and the ECB sees that as well, and that's why they're topping out at 4%.
So why are you bullish on the euro?
Well, in the piece we just published, we're neutral, and I think the reason is this US exceptional story because of delayed pass-through. And if you look at Europe, rate increases are being passed through very quickly because it's a bank-based system. So most corporates have their loans against banks, so immediately cost of borrowing is going up. That's what's impacting growth. And I think the key question is, when does that catch up with the US? We don't have high confidence. You're about immediately to go into a very soft landing into the US, or a hard landing, so to speak, and therefore we're pretty neutral euro.
Why wouldn't you be negative on euro? Why wouldn't you see more dollar strength ahead?
Point number one, if you look at relative data surprises, they're quite extreme. So the market's really pricing this US exceptionalism versus Europe. If you look at the PMI numbers today, they actually surprised to the top side, excluding France, where there seems to be a bit of a statistical issue. But potentially the market's getting a bit too pessimistic on Europe. And number two, if you look at rate pricing, again, it looks pretty extreme in terms of that Fed ECB divergence.
Speaking to that sentiment issue, being neutral sounds bullish, to be honest with you.
Exactly, that's exactly what it is.
So far this week, George.
I would give you one example. People talk about car exports and how China's taking market share. And everyone has this chart of Chinese car exports going through the roof.
Yeah.
But no one shows European car exports. They're up 20% since COVID. If you look at the Euro trade-weighted index, it's actually at record highs. So the point here is it's not the euro that's weak, it's just the dollar that's very strong. And the euro is actually pretty strong against the yuan, against sterling, against Scandis.
Within 24 hours of the Putin invasion of Ukraine, David Folkets-Landau sat with us, and he said there will be a fiscal response, a fiscal stimulus within Europe. Is this austerity still in Europe? Is the austerity mindset still within Europe, or are we going to see a fiscal renaissance within Europe?
Well, it's definitely changing, and if you look at this year, you're actually seeing the peripheral economies, so to speak, Italy, Spain, they're doing better precisely because of the fiscal stimulus that's flowing through the NGEU. But fiscal is definitely one story that's supporting growth everywhere. So to answer the point on inflation, inflation's coming down because of the supply side, but growth's holding in even in the US because you're still seeing delayed fiscal. So we've got the fiscal rules up for debate, but given the growth slowdown, I doubt we're going into austerity anytime soon.
George, this was awesome. It's always a clinic. Should we move back to London? Should we make that happen?
Absolutely.
You know?
We.
We.
Is this the royal we?
We.
Yeah, all of us?
Yeah, of course.
Yeah, we're all going to go to London. No, I think the timing works a lot better.
Doesn't it? Don't you feel rested? So much more relaxed. You know, wake up, have breakfast, go to the gym, tea.
It's shocking. For those of you in America that have not been over here, the polarity between New York and London has never been greater.
Yeah.
Never been greater.
We'll talk more about that, Tom. If you are just tuning in, welcome to the programme. Your equity market positive here by 0.2%. In the bond market, yields just about unchanged, but some major moves this week. Through 450 briefly earlier on this morning, 448.44 on a US 10-year. Love our audience writing in. People stand in Apple lines to make money in the resale market, taking them back, selling them into other countries where it's hard to get. Chris Hutchinson, thanks for writing in this morning.
A lot of people writing in on your interview with Daniel Levy. I think we're going to play a little bit of this here in the 8 o'clock hour. Why did that make global headlines in 60-plus entities?
Because he barely talks is the short answer.
He rarely. How did you get him to do that then?
We were working
Did you get tickets for Arsenal?
We worked on this for a long, long time, and we finally made it.
Did he give you seats?
I've got no seats. I don't get anything in return. You think I get seats for Sunday?
I thought you only did it to get into the derby here this weekend.
No, the interview was the gift. The fact he never talks and never talks to us.
I didn't know what to expect. I've never even seen the guy, frankly, but it was fascinating.
I think he was pretty open about what the club's gone through.
I was thunderstruck.
He's clearly in a much more comfortable, happy place to talk about the football club because they're doing so well so far, and they've spent a lot of time,
Ian Wright went mental. He went absolutely nuts. He saw
former Arsenal striker.
Yeah, he saw what you did, and he's like, "Who is this guy? Let's get Farrell. What is it? Match of the day? John Farrell, match of the day."
I got some feedback. They wanted the Glazers next. Yeah. They wanted that as the next interview. Todd Bowley as well. We're trying to figure that out.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
The committee left the additional rate hike this year in the dot plot. I think that may be a good thing to do as insurance to make sure that core inflation especially continues to come down. I think the risks are building that inflation could hang up at a higher level or even go higher based on the idea of a reacceleration in the U.S. economy.
That right there is the risk, and jobless claims in the last day or so speak to that risk. That was Jim Bullard, the former St. Louis Fed president, sitting down with the brilliant Michael McKee a little bit earlier this week. The moves we're seeing in this bond market off the back of that risk of higher for longer and maybe a re-accelerating inflation story in the United States, lifting yields higher on a 10-year at the moment, 4.48 on a 2-year. Let's call it 5.13, but getting really close earlier in the week to 5.20. So yields up, stocks down, dollar stronger, equities down yesterday, biggest one-day loss in 6 months. Futures this morning positive by about 0.2% in the FX market. Talked about this number a few times, worth talking about again. 10 consecutive weeks of euro weakness against a strong dollar. The euro against the dollar, Tom, 106.39. That currency pair negative 0.2%.
When we invented surveillance, it is all about what we just witnessed. To see the polarity of the Nomura Deutsche Bank call on the set of currency pairs we look at is the raging market debate that's out there into the end of the year.
Constructive Europe.
Yeah.
He used the word neutral, but neutral, let's be clear, the word neutral is constructive relative to the bearishness we have heard all week about the continent, particularly off the back of the data we saw earlier today.
This is an important conversation, whatever your politics. Roger Bootle joins us now, founder of Capital Economics, and what's important about that is the day they published, they were authoritative. He is a conservative voice in the United Kingdom with a shingle out at the Telegraph often. And we talk to him now, literally big time, going to rip up the script of what we have observed in the London battle of the Conservative Party, maybe an ascendant Labour Party. Tony Blair out, talking up Labour to a great extent. Bootle of Capital Economics. Do you drive an EV?
Oh, certainly not.
You don't, you certainly not, you don't.
I don't drive. I don't need to.
For our American audience on radio and TV, it's basically London is under a debate that's encapsulated in what, Lisa, 2025 United States? Is that where we're sort of heading? Explain to our global audience how ESG and the timeline of the distribution of electric vehicles has been crushed by the Prime Minister, the Conservative Prime Minister.
Yeah, this is really interesting because a succession of Conservative governments following on an initiative begun by Labour laid down a pretty tight schedule for a whole series of green anti-climate change measures, including electric vehicles, heat pumps in houses.
Right.
This has been it's been an extraordinary episode because we all know that the ambition is fine. We want to get to net zero. That's fine. But getting from here to there has always been extremely difficult. And it wasn't clear that we could do that with existing technology, and it wasn't clear quite what the costs were. Quite frankly, I think British politicians have played fast and loose with the public.
Well, this is important. Pharaoh's been out front on this, way out front on this, talking about virtue signaling. The Telegraph mentions Rob Henderson up at Cambridge talking about the elites and how they look at luxury belief and lecturing and that. This translates across all of the Western world, and that we know what we're doing, trust us. Is that under threat right now politically?
Oh, absolutely. I think it's very interesting what the Prime Minister's done. I think he's been rather late in the day, by the way, because plenty of people in the Conservative Party have been urging this, but he's realised what the electoral penalty might be for carrying on, and equally what the electoral prize might be, because Labour, of course, have taken exactly the opposite tack. So we're now beginning to see the emergence of clear green water between the two parties.
I think this is really, really important. And what I want to say up front, Roger, this is not about denying climate change.
No.
It is not about that whatsoever.
And Sunak said that.
This is about being transparent with the public about the cost of the transition. And Roger, I think the point that you're making is that we're not being transparent enough about how costly this might be. Can you help us put some numbers on it? Help us understand how hard this is going to be.
I can't put the numbers on it, but let me tell you, and Sunak quoted these figures the other day, what ordinary people are being asked to pay is an extra £5,000, £10,000, £15,000. And the dollar amount's not much larger than that, obviously a bit larger. Now, for well-off people and for the elites, this is chicken feed. But for plenty of people, this makes all the difference between a livable life and, frankly, penury. So it's been, I think, not, frankly, a very edifying episode of the last few years. Politicians living off hope and promise and aspiration rather than getting to grips with the nitty-gritty. As you say, this is not denying the climate change point. There's another aspect I think is very important here. A lot of people don't realise that Britain has been in the forefront of cutting emissions. We've cut them very, very substantially. And of course, the big emitters are elsewhere in the world who, should we say, are not doing that much?
Maybe there's uproar right now because of the financial situation that the United Kingdom has found itself in. And a lot of people in the sort of back rooms are saying it's because of Brexit and it's because of the importation of a lot of the inflation and of some of the lack of trade deals. You scoff. Why?
Well, I have to mark your card if you didn't know. I was a Brexiteer. But even if I were not a Brexiteer, I'd find it really rather tiresome, the number of times that people just trot out Brexit as the explanation for everything that's gone wrong in this country. There's plenty wrong in this country, and there's been plenty wrong for a very long time. Nothing whatever to do with Brexit. I think it's quite clear, really, although Brexit has probably had a disadvantageous effect on the British economy, which I don't find entirely surprising. I thought that would happen. The scale is minimal, frankly. Look at the trade figures. Look at how we stack up against other countries. Germany has done far worse than the UK. And as far as I know, Germany hasn't left the EU.
Well, but some people argue that the lack of labor is directly tied to some of the immigration barriers that have sprung up from that whole affair. You're shaking your head again, but there is this question of, well, what are some of those effects? How much does that factor into the uniqueness of the inflation and slow growth that the UK's in?
Well, I don't think very much so, because the fact is that last year we had record levels of immigration into the UK, absolutely massive. Now, the difference is now these people are, of course, coming from outside the EU. Now, there could be something to the idea that EU workers were particularly prominent, as indeed they were, in the hospitality sector, and there's not a direct substitution between the workers coming in from the rest of the world and the workers that used to come in from the EU. That's possible. But there's something else here, you know. During this period where some sectors, including hospitality, have been suffering from a shortage of workers, public sector employment has gone through the roof. You might just as well say that the problems have been created not by Brexit, but by the overexpansion of the public sector.
75 years, I'm looking in the right column of a given paper, and the doctors are on strike at the hospitals. The NHS, by every estimation, including our NHS expert, John Farrow, is completely broken, busted. What can Americans learn from the failure of British medicine?
Right, well, first of all, the NHS is by no means the only, as it were, non-American alternative available for the health service. I mean, I'm not a great admirer of the NHS, nor am I a great admirer of the American system, by the way. And I think one's got to think clearly and with imagination about what's on offer. Australia has a good system. Singapore has a good system. I think France has a pretty good system, actually, where you're asked to pay a sum to visit a doctor, always. And if you really are against your limits financially, you can reclaim that amount. But the idea is you're asked to pay. I think the British system of not having to pay for anything is straightforwardly bonkers.
Yeah, Uwe Reinhardt, Princeton, the late, great Uwe Reinhardt. Australia is the model.
I think the thing that people outside of the UK don't quite understand, particularly those in the United States, you can still have a private healthcare plan in the United Kingdom. That seems to be lost in this debate whenever I hear it come up. You can have access to the NHS and also have a private plan. If you work in an institution like Bloomberg in London, you will have private healthcare on top of your access to the NHS.
True.
And I think on a percent of GDP, the US is 16, 17, 18%, and UK is 10, 11, 12.
Yeah, some people might say the US figure is a little too high, to be honest with you, Tom, but we can have that debate another time.
One good thing about the NHS, there are some good things, is it has helped to keep down healthcare costs. The problem with the US system is you get massive inflation in healthcare costs.
Can you come back and actually talk about capital economics at some point? we didn't
start the conversation there next time.
It's Friday. Tuesday we would have done capital economics.
Roger, it's always a pleasure to see you, sir. Thanks for being with us. Roger Biddle there of Capital Economics. Take the tension of things in the United Kingdom at the moment.
I'll be blunt, folks. The newspaper debate here, Bloomberg News, FT, 47 other newspapers I don't know. It's so much richer, John. It's such a more complex.
What do you think the difference is?
Screaming. There's more units with Mr. Murdoch retiring. He's the one that invented it. There's just more units. I've been reading the Sun.
I would say this about the UK papers. I think they're far more transparent about what their politics are.
Yeah, I mean, I look at page 3 or page 6 of the Sun, and, I'm learning a lot about the British system.
Sarah Malik of Nuveen is coming up next. Your equity market's positive by 0.2%. From London, good morning.
What strikes me about these technologies in particular is that the brain is that last fortress, and our inner self is the thing that defines us. And yet we're at this turning point where that inner space could become part of some business's private enclave or some government's Orwellian fantasy.
So I worry about this deeply. And I worry that that final private space, the space that I think is so critical both for self-awareness and for resilience, for the ability to know truth from fiction, the emotional self-reflection and cultivation, is at risk of brain transparency.
You mean the idea that we can just be seen through entirely?
Essentially, right? I think the way we define intimacy in a lot of relationships is by choosing what emotions, what thoughts, what secrets we want to share with another person. And if all of that can be revealed by decoding your brain activity, if other people can have access to it, whether it's your partner who says, no, I want you to prove that you're in love with me, or a lie detection test by the government, or the way you authenticate yourself at borders is through brain transparency, I think this final space of mental reprieve is at risk.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
I think we roughly know what the impact of monetary policy is so far.
I think the real core question kind of haunting markets at the moment is what is the neutral rate?
We're much more dovish on the Fed, and in general, we're much more dovish on growth.
A stronger dollar will be much less damaging to the United States in the short term than it is to other people.
Unfortunately, we need a recession to really correct some of those imbalances.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene in London, on radio, on television, on a Friday. And all we know is things have changed. After 3 central bank meetings, I've got to harken back to November 2008, John, because you're hot, then you're cold. You're yes, then you're no. You're in, then you're out. You're up, then you're down. The 10-year real yield is up. We are back to yields back when Katy Perry was telling us you're hot and you're cold.
Did you just want to sing that song?
I just did. I just honor Katy.
I think you've got to go back to 07 for where the yields are currently.
Katy this week sold, are you ready for this? She sold her publishing catalog this week to David Rubenstein.
Very cool.
To Carlyle.
Didn't know that.
That's what triggered in my head. And I said, what was Katy doing? In November of 2008, you've heard John Farrow talk about the yield structure that's out there. We're back to 08, 07, 06.
I'm sure David appreciates that rendition, Tom. But certainly, yeah, we've seen some massive moves in this bond market this week. It's been phenomenal to see the 2-year pushing 520, to see the 10-year going through 450, and still sitting here asking the question, are we sufficiently restrictive? Are we? The Federal Reserve thinks perhaps we are, based on the economic data we've had so far. There are others out there, Tom. I like to pick on Neil Dutta of Renmac often. Neil Dutta thinks maybe we're not. Maybe this economy could re-accelerate.
And pushed against the shock of the yields. Let's go to Krugman talking about plain vanilla disinflation coming in. George Saravelis making the idea of the granularity of month over month or 3-month annualized statistics, as Furman of Harvard talks about. The answer is there are disinflationary trends in place. Lisa, it's not only the U.S. Saravello suggests disinflationary trends in Europe.
How big are those disinflationary trends? Are they enough to really keep the ECB from hiking further, and whether they're going to drop rates lower? I think the big sea change this week is just the longer-term yields going higher. This is not being driven entirely by the front end. And yes, I am going to have Katy Perry in my head for the rest of the day, and we can't really move past that time. You're not allowed to start on such a distracting
You've got to see how he plans this show.
I mean,
we're both sitting there with the Bloomberg terminal sitting in front of us, and Tom's scrolling through the lyrics when Jordan Rochester was on.
What are you looking at?
Trying to work out what song and which verse he's going to use.
And that was
Have you got any more?
Babe.
Was that?
Look, seriously,
was that singing? Does that count as
we're
singing?
going to interrupt the show here first.
We just did.
There's a great photo of a guy.
Now you're asking for permission to interrupt the show.
I'm interrupting the show right now to tell you that there was a great photo of Mike Bloomberg with Sir Paul. And one of the things to do in London right now with Bloomberg Philanthropy support is to go over to the newly opened National Portrait Gallery and see Paul McCartney's black and white images from 1963-64. And when you're over there, she loves you, yeah.
Oh,
yeah,
come on.
Love like that.
We're going to turn to the price action.
Please.
Let's do a data check.
CK's going to work on
Sarah
its next
Malik's
song.
going to walk off the set.
Sarah Malik, I hope, is still there. Equities on the S&P positive here by 0.3%. Yields come in a single basis point of 448. If you want to know where crude is, back in the 90s, up $1.04 today. $90.67, up by more than 1%. Right. And the dollar is stronger against the weaker euro, 106.43.
I want to hold her hand. Sarah Malik with us now, Chief Investment Officer at Nuveen. Sarah, the fear is out, price down, yield up. Should we be in a sense of panic or frenzy or caution, or is this a normal adjustment that we will survive?
Well, there's two issues the market needs to adjust to, and that's what's going on with the economy and what's going on with rates. The economic soft landing narrative is definitely being challenged, and the markets had started to price that in. So that's what the markets are adjusting to. And rates, of course, interest rates higher for longer, inflation higher for longer, all of that together is going to be a headwind for the markets also. We think long-term, a lot of cash still on the sidelines. So I don't think the bull market's over, but short-term, you do need to be a little bit cautious. The two areas we like are technology stocks and dividend growers. Technology stocks still less correlated to economic growth, so I think they can have a rebound from here. And then dividend growers is an area of the market that's really underperformed year to date, and they tend to perform well in markets that are going down, so they have less downside capture. So those stocks I think are cheap and could protect portfolios and provide income.
Sarah, what you just said is actually incredibly controversial today. It might not have been controversial 2 weeks ago, but today, basically, you're going against everything that everyone is saying at a time when you have tech going down to such a degree and leading the declines. So how is tech defensive at a time when they potentially could be interest rate sensitive and when they have exploded? The big seven magnificent stocks have absolutely driven everything we've seen so far in terms of gains in the U.S. equity market.
Well, let's start with semiconductors, which is an area that we like. September tends to be their seasonally worst month in terms of performance, so not surprised to see that. They peaked out in about July, but if you look at the tailwinds for semis and software, which is our two favorite areas of technology, first of all, artificial intelligence, we don't think that it's hype. It's a real trend. It did get a little bit crowded, but I think it'll last for many years. Second, inflation has been increasing because of energy prices, which we think will moderate after the huge upswing that we've seen, and then continued services spending, which has been around for a while. That continues to moderate, another tailwind for technology stocks. And interest rates, we see the Fed basically one and done from here. One more rate hike. What got priced out of the market next year was 2 rate cuts. We didn't expect rate cuts for 2024, but as the Fed pauses again, I think these are all positives for tech stocks. So a few of these headwinds that have come in the last 2 months, as the sector did get crowded, will move out of the way. Also, looking at portfolio managers, they generally were underweight some of these mega cap tech stocks coming into this year. So you could see a lot of people stepping in for catching up to get their weighting in their portfolios to the right level. And then clients are holding still about 25% of their portfolios in cash. That at some point needs to come back into the markets.
Does it though? I mean, this is sort of the key question. Does it, if you're earning 5% on it? Actually, maybe it looks pretty good. And there's a question about whether we've actually seen the effects of rates that are now the highest going back more than a decade, 2007, 2006, depending on which denomination you look at. Are you saying that these are rates that we can live at? That basically we have seen the effects and they haven't been too bad?
Yeah, I think what clients learned this year was there was an opportunity cost for holding cash, especially when inflation is at the levels that it was, and the markets have done what they've done, year to date, even though they've moderated a bit in the last couple of months. Markets are still up well above cash year to date. So there's an opportunity cost for holding onto that cash. So I think clients are figuring that out. And when it comes to high interest rates, the 10-year at over 4% is a headwind for the markets, but it all depends on what economic growth does. And if economic growth stays strong, I think the markets can handle a 10-year that's at these levels.
Sarah, this discussion on technology is so absolutely critical. A huge body of retail is taking the story if institutional is not. Now, the gloom is rates up. There's a duration argument about technology. I get it. Where in the income statement will you see tech superiority? Are they going to outperform on revenue growth, or do you go down where they surprise with a better marginal free cash flow?
The answer is all of the above, in the sense that the good news for software companies is they don't need to rely on pricing power. And as inflation does continue to moderate, which we think that it will, software companies are less affected by having to lower their prices and hold on to pricing power. Margins are important for tech stocks. We saw that with Meta this year, where they were ahead of the curve in terms of cutting costs and preserving their margins, and other companies have followed, which is important too. And then strong free cash flow growers. You look at Broadcom right now as a company that we like. Strong free cash flow, ability to buy it back up to like 9 billion in shares. VMware is going to add free cash flow to their model. So all of the above for these companies.
Lisa's buying a new iPhone today at Covent Garden. Sarah, should she be also acquiring Apple shares at the margin?
Apple is a company we've not been as bullish on for many reasons. Number one is the post-COVID normalization of their unit growth, I think, is going to be an issue for them. And even with the upgrades to the iPhones, I'm a user of an iPhone myself, but upgrades have been pretty incremental recently, so they're not as exciting. I'm glad Lisa's excited about it, though. And also, their next big product is VR, which has a very high price point. So I think those could be struggles for Apple's, which has got premium multiple, as people have that's been a consensus holding for many investors.
I just want to set the record straight. And Tom, you know this. I am not a line waiter. I am not someone who's some sort of rabid enthusiast. I cracked my phone, so at some point I'm going to have to get a new phone.
They're going to be in Covent Garden lined up. They're going to be, oh my God, it's Lisa Bremo. It's surveillance. Can we do a selfie?
Let's move on. Sarah, I'm curious, though, just as we sort of take a look at the whole week, is 60-40 still profoundly challenged at a time where we're seeing bonds sell off at the same time in tandem with stocks?
It was challenged in 2022. I think 2023 has had a better return for the 60-40 portfolio, but it taught us a lesson about diversification and alternatives, an area we really like outside of the traditional 60-40 is private credit. It also tends to be resilient to an economic slowdown, and I think that's really important right now, is owning areas in your portfolio that are less susceptible to economic slowdowns, can continue to grow. I did also have one more question for all of you, though. You talked about Katy Perry. Are you in the Katy Perry camp or Taylor Swift?
Oh, well, I got to go with Katy, frankly. But I love what Taylor's been doing with the National. I mean, she and Antonoff, what they've done has been extraordinary. She's moving the needle on GDP. I mean, can Olivia go out there and move the same needle?
You're asking him.
I'm not engaging. That's all. Was that a question for Sarah? Or
no, it was for you.
All right.
You're going to try to just completely ignore it.
Sarah, she's ignoring me. It's Friday. Thank God.
Of Nuveen. Wondering what on earth she's walked into. It took us about 2 hours and 10 minutes to ask a serious question this morning, and it was Bramo.
No, this was
does 60-40 work?
But this
60-40 work. Everybody sits down with a financial advisor. They walk into the room for people who don't know about investing, and they get told, "Do this." You ask them
You're
why.
100% correct.
They give you a reason.
I also disagree with
And then they look at your portfolio,
yeah.
and they're going to look at things right now, and they say, "But I thought you said that when this happens, and then this didn't happen yesterday at all."
Well,
Treasury's down. Stocks down.
Yeah, but even over the last 18 months, if you look at the Bloomberg Total Return Index, 60-40 is tanked. And what's so important there is what Malik says of Nuveen is the zeitgeist of successful retail investing now. They bought 7 stocks as a generalization, and they're not selling them because they're the memory here. The memory back 3 years, 5 years, 10 years just says keep the apple, own it, and buy more.
That's enough. Give us another verse.
This zeitgeist. No, I just, I mean, Lisa's out there. She's going to be over at Covent Garden, and she's going to get up and shake the glitter off her clothes. That's what you get for waking up in London. I mean, that's what Lisa's going to be doing.
Nice. That's good. We've got another 40 minutes of this, haven't we? 50 minutes?
It's Friday.
Can't wait.
We did the thing. What we do, we have a huge tradition, folks, where we pulled a strip, and Lisa won it. Lisa's going back in the Gulf Stream.
Very cool.
Yeah.
She gets the plane. Yeah. Nice. If you're just tuning in, welcome to the program. The S&P 500 positive here by 0.3%. Coming up shortly, in about 15 minutes from now, we'll catch up with Janet Henry of HSBC on the global growth backdrop. 3 big central bank decisions, no change at all 3, but there's one we've hardly talked about, and it's the BOJ. The BOJ just not really part of the conversation because they're looking at inflation in a completely different way, Lisa, compared to everybody else.
Because they're not saying anything. They're not saying what they want people to tell, like what they want people, what people want to hear, which is, when are you guys going to actually move? When are you going to recognize that data that you're actually looking at? And UAIDA's saying, we're not going to give that to you, so sorry, go home. And so we all are.
For them, it's not a problem, Tom. It is a solution to the issues they've had there for the last several decades.
I was honored, I kid you about tea. I was honored to take tea at the Bank of Japan a number of years ago, and it's from another time and place. This has nothing to do with modern monetary theory. The institutions are in place. They make the rules. These are the rules until.
Can I just say one thing in terms of clarifying all of the misspeaks that we've been having this morning? You say that I'm going to be on the Gulf Stream or whatever.
Well, it's a chief,
And I just want to let you know something, that when we were coming home from Jackson Hole, the guy at the security counter said to me, why aren't you on the jet stream? Why aren't you on the Gulf Stream?
Yeah.
And I was like,
Did you tell him that I had the G6? Did you explain it?
I explained to him that you drew the straw.
I mean, to be honest, it's a little unfair
to them.
Oh, obviously.
You're
right.
No, but in the old days, Francine hogged the thing. She had it nonstop, jetting around doing the leaders with Lacroix thing. But now, it's more fair. It's a more equitable distribution.
It's a more fair distribution.
Democratized.
Yeah, democratized.
Nice, nice. Communist even, almost.
Don't talk to me.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone. Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
He's there, the kind of upside.
How do you compare the pleasure of being Secretary of State, Senator, First Lady with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
A little bit of strike fever is kind of coming to fruition right now. And when people get concessions, when labor unions get concessions, other industries, other labor unions say, wait, maybe we should do that too, or we can do that. It's not a frivolous decision, but it's a strategic decision.
Wendy Schiller of Brown University on the UAW strikes, the conflict, the tension between that union and Detroit's big three, Ford, GM, Stellantis. There is a new deadline for further progress. midday today, Eastern Time. And if we don't see a sign of that further progress in the next couple of hours or so, we've got a Facebook Live. We calling this a press conference, Bramo? What are we calling this, an address?
What is it? Yeah.
Facebook Live address taking place at 10 a.m. Eastern Time with the UAW president. Going into all of that, this is how your day is set up going into the weekend. Let's get you to that weekend as quick as we possibly can. Your equity market on the S&P 500 positive here by 0.3%. That's about from the biggest one-day loss going all the way back to March and all the banking difficulties that we had in the first couple of weeks of that month. In the bond market, I don't think the call was ever to see cycle highs after that tension, that those issues in the banking system in America back in spring, but to see cycle highs off the back of it 6 months later is phenomenal. We are pulling back a little bit. We're down 2 basis points on a 2-year to about 512, down 2 basis points also on a 10-year to 447. But to give you an idea, I don't know if you've been on vacation, hiding under a rock, in the last 24 hours, 2-year getting close to 520, 10-year in the Asian session going through 450, just stunning to see.
We do this every day where we're completely jaded by it. We're, you know, it's been sudden in the last 48 hours with the 10-year real yield out to 2.11%, I believe now 2.09. But John, you know, you get off the plane in New York, and what's the first thing you think about? What's a 30-year mortgage rate going to be? I mean,
pushing
does
8%.
it go back out to new highs?
Pushing 8%.
You know, do you nudge up?
I think number one question we've asked is the right one. Okay, that's the mortgage rate if you wanted to go and get a mortgage right now.
Right.
How many people are going to get a mortgage right now? So you've got the price of money and then the price people are actually paying, given the agreements they've made over the last several years. So when do we start to see that great refinancing? Where in our future is it?
And again, it permeates for me down to a real yield and an inflation-adjusted yield. Let's remember 2.x% in the United States positive real yield affecting all, in the fiction of the United Kingdom where the real yield's still a massively negative statistic.
The unknown. Tons of uncertainty about the inflation story. But Tom, if they are seriously high for longer, if they're taking away all those cuts for next year, and if you're going to see inflation continue to make improvement, disinflation, then that real rate, Tom, gets even more destructive, doesn't it?
Absolutely. There's no question about it. And you know, we go to the residual math here, but that's going to be a huge theme into October. One of the themes we know is Keith Naughton and our team in Detroit will be glued on Facebook at 10 a.m., maybe to find out what modern UAW's strategy is. If you're weaned on Walter Reuther, if you're weaned on George Meany of the AFL-CIO, it's a whole new world to provide wisdom with huge depth and perspective. Naughton of Detroit. Keith Naughton, I'm just going to cut to the chase. It's a whole new world after all. What have you learned about this new negotiation of 2023?
Well, it's really guerrilla tactics, Tom. You know, they are taking out different plants at different times. They're trying to keep the companies off guard, keep the companies guessing. So yeah, what we will get today is UAW President Shawn Fain will announce the next round of strikes. They've already struck 3 plants, one at each company, as you know, and they're going to probably strike 3 more. The question is which plants they'll be. Will they take down the big pickup truck plants that provide most of the profits for the big 3?
Each of these companies has a different character. I think that's underplayed. We sort of amalgamate everybody into Detroit and their immense support of the Detroit Lions. Forget about it. Which company are you watching? Which culture in Detroit will give you signals about a successful outcome?
Yeah, I think the company that's in the lead is Ford. Ford has traditionally had the best relationship with the United Auto Workers. They've actually made 4 offers to the United Auto Workers so far. They were the first to give an offer. As you know, Bill Ford, the executive chairman, great-grandson of the founder, he showed up to make a proposal in person, their most recent proposal. Shawn Fain stood him up.
Keith, what's the big holdup? Do we have a sense now? Is it really the salary? Is it the mix of products being manufactured? Is it the sense of guaranteed workers at a certain level, at a certain number of plants?
Well, it's really all of those things. They are very far apart on wages. The union has come down from a 40% request to a 36%, and the best the companies have offered so far is a 20% from GM and Ford, 19.5% from Stellantis. So there's a very wide gulf on the wage demand. But yeah, they're hanging over these talks is the electric vehicle transition and the battery plants that all these automakers are building. that are not yet organized by the UAW. The UAW wants to make sure those future battery workers will get the same wages, have the same benefits as the existing UAW workers.
Keith, when you say that these sides are very far apart, you talk about the distance between the two, and I think about how inventories are going to start being bought down of some of the dealers, the auto manufacturers as well. How much do we expect auto prices to increase? How long does this have to go on before people feel it materially when they go buy a car?
Right now, inventory is pretty good. The automakers really built stocks in advance of this, so industry-wide, the day's supply is 58, and what's considered ideal is 60. So right now, there's a pretty good inventory situation, but the more plants come down and the longer this goes, then it starts hurting.
Keith, what's your timeline? The one thing I can't get out of experts, I mean, I got a lot of punditry and that, but you people are so informed. I mean, even Craig Trudell over here in London is somewhat in the game. What's the Bloomberg timeline, your best guesstimate of this strike?
Well, we've spoken to one analyst who thinks that it can run to the end of October. It's very hard to know. There's some stuff that came out overnight, some texts from union sources that it looks like they really want to make this go for a long time to inflict pain. So it doesn't feel like we're very close to a resolution.
So are we talking F-150 now, Tom? Are we going that far?
They're going to go to the emotion of pickup trucks, which is the lodestone for certainly. Well, I'm going to go all three as an amateur, but I defer to Keith on that. But
Keith, just to make it really simple, is that like the last thing that they reach for, or do you think that's the next thing?
It could be the next thing that they reach for. If they really want to inflict maximum pain, you take down the Ford F-150, the best-selling car in America since Ronald Reagan was president. You take down the Chevy Silverado, you take down the Ram pickup truck. Those are the cash cows for Detroit. Those will cause pain immediately.
Well, Keith, the big hang-up here is how much money they have left at the UAW to keep paying people who strike. I mean, are they going to try to use it up? Do they have a limited amount of time, or do they have a lot of runway?
Yeah, so they have $835 million in their strike fund, and they're paying $500 a week to strikers. But so far, there's only 12,700 strikers because of this targeted approach they're taking. That's how they can conserve money in the strike fund. However, the companies are laying off people because there's this ripple effect that happens when plants go down. And the union has agreed to pay those people getting laid off as a result of the strike from the strike fund as well. So that will deplete it faster.
Interesting. Keith, thanks for the update. Keith Norton there of Bloomberg, looking ahead to this Facebook Live event at 10 a.m. Eastern Time, ahead of the supposed deadline of midday Eastern to make sufficient further progress. I sound like Chairman Powell over at the Federal Reserve, but we're looking for sufficient further progress in talks, Tom.
Well, you know, I'm glad you brought this up. And, John, the pickup truck thing is certainly very emotional, but I was thinking, you know, based on all my knowledge and heritage here, you know, I just think UAW, they really ought to go after the Pinto and the Javelin. I mean, that's really... You know,
do you want to explain what the Pinto and the Javelin is?
The Pinto and the Javelin to foreigners like you is when we started buying foreign automobiles. They were so bad. They were so poorly designed. There was also something called a Suzanne Vega. A Vega. There was a Pinto.
You can't say he's a foreigner in the UK when we're in London. You can't say that.
No, do that when I'm in America.
I know, exactly.
No,
I mean, it's like you
the
can't
bottom
do it
line,
either.
no, but seriously, when did we start buying foreign automobiles and why? It was because Detroit invented and engineered these monstrosities. They were all glass. They weighed a ton. They couldn't go around the corner.
The thirst for bigger cars.
And we said we want to buy a Renault. We called it a Renault, I think then, and a Puget, and the rest of them.
Say that again. Say that again. The last one. The French.
The Puget. It was a Renault. You bought a Renault Dauphine. The rich kids' fathers had a Renault Dauphine.
Did they?
And the rich art students, the art chicks, they had a BMW 2002.
How much of this have I got to get through? Another 30 minutes, something like that. You're going to stick with us at home, I hope so. Yeah. Henry of HSBC is going to join us shortly. Seema Shah a little bit after that. All of that in the final 30 minutes of whatever this is. Live from London, this is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
He never stopped, for what it's worth. There was a break of about 3-4 minutes, but the conversation continued, and I'm still none the wiser. If you are just tuning in, congratulations. Your equity market on the S&P 500, positive here by 0.4%. Session highs on the NASDAQ as well, up by 0.7. A lift off the back of the biggest one-day drop, going back 6 months to the month of March. In the bond market, cycle highs, a 2-year, a 10-year. A 2-year earlier this week pushing 520, backing away this morning, down about 3 basis points. But to see a 30-year in the 450s, a 10-year in the 440s, and briefly overnight in the Asian session, a 10-year at 450 is just absolutely phenomenal. The Fed might be signaling maybe they're done hiking, but it's going to be at this level for perhaps a whole lot longer based on the way we've internalized that message in this bond market, Tom, this week.
George Saravelis gave us a window. He published literally in the last 30 minutes their outlook into the end of the year, and every shop has to do that. How do you publish an outlook with yields moving like this? You got to go, what if higher? What if lower? What if disinflationary trends click in?
Well, you had a dummy run from the Federal Reserve. How did that go on Wednesday? They published an outlook. Then got a bucket of freezing cold water and just did that all over it and said, yeah, about that, no.
To me, I just think that there is one logical conclusion that we can have, and I feel like people are kind of dancing around this, which is that no one in the U.S. is paying the rates that are exactly being quoted,
the transmission's
except for the U.S. government. That is it, right? Basically, the new bonds that are being issued, and even then, only on the margins. So how can we really say that we've seen the effects of this, right? But then how do we say that we are ever going to see the effects until 10 years later when all of these bonds mature, et cetera? So at a certain point, isn't this an economy that's just completely immune to rates and are going to have to go a lot higher than people previously thought? I mean, why is that not
we'll work through it.
part of the discussion?
For corporations in the next year, high yield, we know there's a maturity wall out there.
Right.
They'll have to pay it. If you wanted to buy a new car right now and you weren't paying cash, you'll have to pay it. It's just taking longer than I think we thought it was going to take, particularly when it comes to the mortgage market. Housing, I think housing's just its own beast. 30-year fixed, you're holding on to that 2% mortgage, you're not letting go, are you? So that's its own beast right there. But other parts of the economy, they'll feel it over time. Whether you need to wait or go further is part of the conversation. I think we're going into this quarter where we're hearing the same old story. That's the problem I've got with this fourth quarter. The fourth quarter, it's the economists that cried recession, and no one believes them anymore.
Right.
So now we're stacking up a whole new load of issues. Student loan repayments, headwinds coming from energy, et cetera, et cetera. No one's buying it anymore. No one's buying it anymore at all.
People believe in the strength, and that's why we're seeing yields get to such highs, even though everyone was saying, buy the long end, it's going to definitely go lower and go back to something more normal.
5 days into this sojourn in London, and after our great credit conference, we haven't even talked about Jim Zeltner on fire yesterday.
Yeah. He's fantastic.
At the credit conference. I was like, you guys were going with him as bond people, and I was like actually listening to the state of the industry, which I never think about, but very, very cool. Thanks for the comments on that. The Julianic Memorial Credit Conference that we did there, I thought that was very good yesterday. We needed a voice near the end of our sojourn to provide balance and a view forward. There's no one in London that can do that, like Janet Henry, global chief economist for the Hong Kong and Shanghai Banking Corporation, wired into Asia, literally like no one we talk to. You've got a lovely view. And then there's China. What does HSBC, with all of your contacts, say about the stability and the economic recovery of China?
HSBC has a perhaps more balanced view of China than some of the hysteria that hit the markets not so long ago. I think we're not going to get any quick answers one way or the other on China. And we need to learn to live with that. You know, financial markets always want to know with certainty where things are going to be in 2 years' time, and they want to price it today. The fact is, in China, what we have seen recently is some signs of stabilization in the economy. Industrial production showed some improvement. Retail sales showed some improvement. Credit data is showing some improvement. Are there still major challenges in the property sector? Yes, and we are seeing a gradual rollout of policy stimulus that is now being reflected in monetary data. Are there major issues in local government debt stocks? Yes, there are, but are they providing liquidity? Yes. This is a multi-year story of ongoing stabilization, and the next round will be structural reforms to deliver the long-promised higher quality of growth.
On monthly and 3-month annualized, and within your research note, we see a disinflationary tinge. That dovetails with Steve Major's long-term conviction of price up, yield down. That's been tested the last 72 hours. Do you guys stand with a disinflationary tendency which filters in to lower yield?
Well, from a macroeconomic perspective, for the last 2 years, Tom, as you know, I've been talking about a deterioration in the growth-inflation trade-off, a different mix of lower growth, higher inflation, and that probably requires a different policy rate level than we were used to in a pre-pandemic era. Yes, we have some disinflation, but there are plenty of risks out there. Even the Fed's Goldilocks view that they set out at the FOMC, the level of uncertainty around that they are admitting is quite high. But by the same token, it's not so long, as you've already highlighted, that everyone was forecasting a recession. First half of last year, this year, second half of this year, now a soft landing. The fact is, this is an unusual cycle. The last 3 years were unusual. Why does the market keep fitting with the idea that this is going to be a very ordinary downturn with a very ordinary Fed response?
Has something changed, Janet, from your perspective, the relationship between the labour market and price pressure, just based on those forecasts? And Chairman Powell himself hesitant to ascribe a narrative to a median projection, but let's have that conversation anyway. We have done over the last couple of days. They're essentially saying we can get inflation down to 2% with unemployment not climbing much above 4%. What do we learn from that?
We've learned that they are extrapolating what's happened so far.
Right now?
Yes. So you're right. I mean, it's remarkable. We've never been in the recession camp. We've been in the more protracted slowdown, the rolling recession camp, a couple of years of sub-trend kind of growth. But now the Fed has overtaken us on the unemployment rate. You know, we only had unemployment at 4% by the end of the year, but we've got it at 4.5% by the end of next year. The Fed hasn't even got that, having previously said that it was going to rise by more. It has been extraordinary that wage growth has gone from nearly 6 to just over 4. But the recent progress has actually been a bit slower, and everyone's talking about the strike. We don't know. It could be that actually there are other areas of the economy where, because of collectivized wage bargaining in Europe, because of public sector pay in the UK, because of strikes in the US, that it's not a linear story. Actually, it's a bit rocky on the way down, and the disinflationary process, as we've discussed before, is not continuous. We've got other areas of inflation volatility, and the markets are going to have to accept that they really are willing to keep interest rates higher for longer.
For people who go on the Federal Reserve website and they open up the summary of economic projections, should they view them as forecasts or aspirations? What are they?
They should view them, obviously, that every central bank, given their inflation targets, their inflation priorities, that is their primary goal, and they will do what is required to get there. Obviously, what we got in the Fed projections, and to some extent we've got in other central bank projections as well, is that they're almost willing to take a little bit longer to get there. The Fed is saying it's not going to be at target till 2026. And they have said that their central scenario is now that they can get there by being a bit slower, a bit more patient about getting there. They can get there without a traditional recession when the economy has some kind of deep contraction. But as no one ever reads to page 2, page 4, question 4, question 5, what's your certainty about this range of forecasts? It's still very high. It's not where it was during the pandemic, but it's still high.
Are you basically saying that what we're seeing this week in markets is a sea change about our understanding of central banks' patience with such high inflation, that they will tolerate it for quite a bit longer, and that means it will become more entrenched in a way that people previously had not expected?
I'm not saying they will tolerate it staying at these levels, and they certainly will not tolerate any signs that it's reigniting, whether that's from wage pressures or elsewhere. They need to see further progress. They need to be confident that that progress is going to continue. And obviously financial markets, at the first sign that maybe a central bank is done, is celebrating the fact that the next move is going to be downwards. And actually, the more that financial markets do that, the more likely it is that a central bank that's trying to tighten financial conditions actually stops raising rates. So I think that what they're telling us is that they are determined to drive it lower. They might be patient about the timeline with which they get there, but they're not going to take any risk that it becomes entrenched. You had that from the Bundesbank again overnight.
The game theory that you just laid out, does that mean that the yields that we're seeing now are finally self-fulfilling and will actually create or foster the tight credit conditions that are necessary to get to the Fed's and the other central bank's goals? I mean, in other words, do you think that these are sustainable, or do you think that this is what we need to get lower?
I think how financial markets react, obviously I'm just a macroeconomist, will be a function of what central banks obviously do. But the central bank is trying to tighten financial conditions. It's trying to slow demand. They still think by slowing demand, they can impact on inflation and ensure that the inflation continues to slow. But we keep talking about all of the uncertainties that are still out there. We've got a renewed inflation volatility, not least from oil and from food. We've still got uncertainties regarding labour markets. The truth is they don't know what they're going to have to do, which is why, as well as saying we're ready to raise rates higher, we're ready to keep them on hold for a very, very long time, it's actually all still about the data dependency. So, yes, they're still watching all of these factors as long as they can see progress, whether it's a consequence of higher yields, whether it's a consequence of what's happening in equity markets, whether it's a consequence of what's happening in spending behaviour. As long as they see the inflation data coming down, that will be enough to become more confident about the medium term.
I have to ask this question. It's with immense respect for what HSBC and like Bloomberg went through with COVID. I mean, we've heard from the quarantines of HSBC and the travels during COVID in China. You walk out of the Bloomberg building in Hong Kong, you go across that historic tramway, and there's one Queen's Center, your building, your place. It's the foundation of Hong Kong finance. What's the stereotype right now we most get wrong about the new Hong Kong?
That is a very broad question.
Well, it's a Friday, so we know
it is a Friday. But actually, you know, as an economist, I always think that sometimes we think about countries. You know, obviously as an economist, I love it that people want to talk about countries. They want to talk about central banks. But a lot of the things that happen, whether it is in Hong Kong, whether it's in Dubai, whether it's in London, whether it's in New York, is actually more about sectors and it's more about companies. So whatever view you have regarding the macro story, when we're thinking about where the true transformational shifts lie in the coming years, and a lot of it is in technology, there is still a lot of dynamism and there's still money being provided to companies.
I'm going to make some news here. 10 seconds. Are you a Hong Kong
trying to cause
optimist?
some trouble? That's what you're trying to do.
Am I a Hong Kong?
Are you a Hong Kong
Absolutely.
optimist?
As someone that lived in Hong Kong for 5 years, I'm still a Hong Kong optimist.
Are you done on that subject?
I think it's important. I think HSBC, Steve Major,
agreed.
Janet Henry, these people have a prism in there. You know, all the stereotype blather we deal with. Our Steve Engel.
Since we're causing trouble, I miss David Bloom. I miss David Bloom.
Yeah,
so much.
Well, he's trouble.
He was great.
You know,
he was trouble too.
He was trouble.
Janet Henry, thank you. Of HSBC. Appreciate it. It's good to
Fabulous.
see you. If you are just tuning in, welcome to the programme. Equities right now positive by 0.4%. Yields a little bit lower by 3 basis points to 446.81 on a 10-year. Seema Shah of Principal Asset Management is coming up very shortly, Bramo, to round out our week in London before you head off to New York?
It's been quite a week, I have to say.
What's your big takeaway?
My big takeaway is that people are pricing in higher for longer, and people are pricing in this idea that it's going to take a lot longer to get inflation under control, and that suddenly there's a question about what that does to the fundamentals underpinning the market. If rates really are higher, suddenly you get those tighter financial conditions that weren't there earlier when people were just expecting the Fed and all the others to cut.
Which I'm listening to people pushing away from that, like Janet Henry and Ms. Malik over at Nuveen. She was starkly opposed to that cautious outcome, starkly opposed.
It was the first time, I think, in the last couple of days where we've started to see those high yields hit risk. I checked high yield spreads this morning. At least they're a little bit wider.
Exactly, that's
given what's happened in the bond market, because they haven't been at all. They're still sub 400 for what it's worth, still pretty tight on a historical basis. Equities right now positive by 0.4% on the S&P 500. To wrap up our week in London next with Seema Shah of Principal Asset Management. Live from the city, this is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
Multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
My feet are firmly on the ground. We've played 5 games and we've started off well, but it's how you end that counts.
The mood around the club seems to have changed. Big Ange, has he changed that?
He's had a very, very big impact. We wanted a manager that we need to go back in time to our real DNA, and we needed somebody that understood that, you know what, there's no easy fix to win. We're very much a club that believes in the academy, producing players that can become hopefully superstars at Tottenham. We're not a club that can buy success. That's the reality, and we have to understand that. And we needed a manager that was completely aligned with our philosophy.
A better mood around Tottenham Football Club going into the North London derby this Sunday. That was Daniel Levy, the Tottenham chairman, talking about the impact of the new manager and the impact that manager has had at the club this season ahead of Sunday's derby against Arsenal. You can watch the full interview with Daniel Levy on Bloomberg's YouTube page and at Bloomberg.com. TK, that's out
play
there
it down.
right now.
Come on, this thing went worldwide, folks. For those of you that don't follow this foolishness, this is the most substantive interview in English football in ages and ages. I looked at one German website which tore about, John, your work, and also 2 other outside sources on the future of Mr. Kane and when he comes back to the United Kingdom. What I don't get is Daniel Levy, with no government funding, with a lot of bank loans, built a palace. He described to you the free cash flow, and he's sitting there crying poor that he needs an academy to build the team. I don't buy it for a minute. Is he one of the rich guys like the Saudis and the rest of them, the Qataris, or is he is poor is he led up?
I wouldn't use the word poor, that's for sure, but I wouldn't use the word rich or as rich as the likes of Saudi Arabia. And compete with sovereign nations is really difficult. The beauty of the stadium that Tottenham have built is it's multi-purpose. So the pitch can go away, then you can have a music concert. The gate receipts, he was talking about the numbers, north of 100 million sterling. That's just for football. Another 30 million.
So Katy Perry can go in and go if it's hot.
Beyonce,
and it's cold,
she might want to
you know.
sing that. Let's see if that sells out. I don't know if it will or not, Tom, but ultimately, yes, and they can raise more money doing that. It's made the club, as far as he's concerned, a lot more sustainable financially and put it on a really good path. The question now is whether he is open to a stake sale. He says he is.
Yes.
He says, like he always says, I've had a duty, as always, to lead the club for the best interest of the stakeholders and the fans for that matter. And if they get an offer, you just get a sense, that openness, Tom, that conversation, a lot of people reading between the lines and thinking that maybe this is a moment where he might be a little bit more open than he has been in the past.
Because of the impact of this interview, two quick questions. Is he looking for a minority sale, a stake sale of 10%?
Unclear, don't know.
Or is he talking about sale of the franchise?
Unclear, don't know.
What would they
All
go
I do
for?
know at this point is there is huge demand in British football, and we've seen takeover after a takeover happen, particularly from the United States. What would a number? I can't throw a number out there. I can say that the Glazers wanted something close to 7-8 billion for Manchester United. They weren't getting the number they wanted.
Okay.
Could it be close to 3, 4, 5?
But it's closer to London, and they have the derby. Okay, well, who's your next interview with?
There's a list.
There's a list?
We've got to nail down the Glazers. So a lot of people giving me feedback to get the Glazers.
Look at Jim Selnick, and it's a Rochester interview.
Get Todd Bowley out of Chelsea. Try and make that happen too.
Okay, well, congratulations.
And the leadership over in Newcastle. Let's do
Huge
that.
impact, and look for David Hillier and all of our English football coverage with Bloomberg News. Right now, Seema's going, is this what I showed up for? Seema Shah's with his Chief Global Strategist, Principal Asset Management, as we finish strong in our week in London. What have you learned of the last 72 hours of central bank football? What's the summary for the principal group?
That the conclusion of the London Derby is clearer than what the central banks are speaking about.
Do you have tickets? Excuse me, guys. Do you have tickets for the Derby?
I don't.
Continue.
No, look, I think the central banks don't really know what's going on. They're really confounded. We've heard from everyone that actually Powell is a little bit confused. As he talked through the conference, the questions, actually, he gave very, very unclear answers, I think. It was quite confusing.
Shah in the same territory as Pharaoh.
So what's your takeaway? I mean, right now what the takeaway has been from the market is that higher for longer. That seems to be the theme. Do you push back? Do you think that we're finally seeing rates at levels that will actually be restrictive enough to bring inflation much lower and to actually create some weakness?
So I don't think rates need to go any further than where they are today, because I still, we talk about the lags continuously. I think at some point the lags are going to come in. Timing is difficult to call, but they will come through. And then if you do another hike, you are risking a bit of an error. So that's what I think. I think, for the higher for longer, it makes sense in light of the kind of 1970s experience, which inevitably is going to be very fresh in their minds. And that probably is what keeps them from cutting rates a little bit longer than maybe they should do. So we're pushing it out to probably the second half of 2024 for the first rate cut because of that concern. What could happen to inflation?
Just taking a step back, are you more pessimistic on risk or less pessimistic on risk after what we saw over the past week?
I'm actually nowhere on this one, which is unusual. It's extraordinary. But the reason is, I'll explain why. So I think that the market is really going to be very range-bound through the first half of next year because there is no very, very clear narrative. If you have high growth, then you have higher interest rates, so it's offset. If you have low growth, it's offset by interest rate cuts. So until you get to a point in the second half of the year where you do get an economic downturn, but then it becomes quite clear that the economic downturn is shallow, and then that's combined with rate cuts, that's when I think when the market can really rally with some conviction.
I've heard 28 flavors of equity belief and conviction into 2024 on this trip. You're writing an outlook now to get to Q4 before your, painful 70-page 12/31/23 outlook. What's your conviction on equities?
That they're range-bound. That is a clear conviction. If I look across, I think that the US is going to outperform Europe, certainly the United Kingdom. So there is still an element of US exceptionalism. I think that the large cap space is going to be challenged, but I want to be a long-term investor in that large cap space.
So you want to capture dividend growth? I mean, just as simple as that.
Yeah, I think that is what it is. You know, we're thinking about income at the moment. That, I think, is the one thing that we can have a little bit of conviction on.
Preferred shares? How's 60s of me? We're talking Pinto and Javelin. Preferred shares?
Investor, you know, even as actually the bonds came back, investors felt like they had been permanently damaged by the events. And they lost conviction, but you've actually seen everything start to creep back. So I think preferreds could be on a decent rally.
I love, you know, I love preferreds and warrants. It's great. I feel like I'm in England, I'm in London, it's railways to India.
Just let's end on this note, that as you take a look at your caution from earlier in the year, and the fact that everyone who was cautious ended up having real regret, and then saying, okay, well, we shouldn't be too cautious, and we can't predict recession. Does that make you fearful of doing the same thing again? Has that sort of been a bit of shell shock that you feel across the street right now?
I think so. I think everyone is confounded by what's happened with the economy. They're confounded by central banks. And inevitably, as you try and switch your calls, you're worried that, oh gosh, you know, everything that I thought is going to start coming through. So you have to have a view on the fundamentals. And for us, the fundamentals I still believe in the lags of monetary policy. I think it will come through, but I think it's going to take a little bit longer.
Seema, this was great. It's good to see you in London. Thanks for being here. Seema Shah of Principal Asset Management. Tom, we got 2 more minutes left. You found more songs?
I teared up. Henry emailed in. Thank you, Henry, for watching. The surveillance team's interviews this morning from London with Stubbs, Rochester, Malik, and Shaw have been worth more than the cost of a month's cable TV subscription.
Very cool.
The benefits of your London week-long relocation have been invigorating. See ya in late November.
Is that your ghost account, or is that real?
No, that's real.
That's real.
I mean, I just think,
believe that.
you know,
I've got no idea.
after Thanksgiving, in time for holiday shopping, you can do another interview with Daniel Levy.
Okay. Let's watch this interview. Daniel Levy, catch the full interview if you can over the weekend on YouTube, on our YouTube page or on Bloomberg.com. Look out for that. On Monday, very cool conversation coming up on Monday. Permacrisis, the latest book with Mohammed Al-Arian, Gordon Brown, and Michael Spence. All three together, Tom. A conversation about their latest publication.
Fascinating, and particularly with the former Prime Minister, to see what Gordon Brown says about New Labour, about their dynamic, how they respond to what the Conservatives are doing.
There's so much to talk about. Also, that title, in and of itself, Permacrisis. Brammer,
it doesn't sound like Michael Spence.
I'm looking your way, Brammer. This is your kind of book.
I mean, this is the whole thing, is that we've been going from crisis to crisis, people planning for crisis, and now we didn't get a crisis, and now people don't know what to do with themselves. If we're not getting a crisis, what are we having right now?
I'm so confused.
The laureate Spence is going to push against permacrisis. He is, you know, optimist.
It's going to be very cool. This was great, guys.
This is great. Thanks to our team.
Thanks for coming back to home turf for a little bit. Back to New York.
Hot brown water was great.
Okay, I'm pleased you didn't insult too many people, Tom.
Thank you.
Just a few. We'll leave it there. Let's try and get TK on a plane and out of London unscathed. From the City of London, thank you for being with us all week. Thanks for the hard work of the team, the producers, for everyone who's put this week together for us. We appreciate it. Live from the city. Good morning.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting, and my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Good morning from New York City. For our viewers worldwide, I'm Matt Miller, in for my good buddy Jonathan Farrow. We're looking at equity indexes, futures that are rising. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up, futures edging higher at the end of a bruising week for investors. The bond rout taking a breather after yields touch multi-decade highs, and the clock is ticking with a shutdown and more strikes on the horizon. We begin with the big issue, countdown to 12 p.m. Eastern.
You look at the UAW.
The UAW strike.
The auto strike.
There isn't a deal that's been negotiated.
Potential for the strike going on longer.
What message does it send for wage earnings growth and how sticky wages may be going forward?
What is that going to do to wages across the board for labor?
Higher wages and margin compression.
That's certainly could be inflationary.
The Fed is going to keep a very close eye on that.
It's going to make the Fed's job a lot harder.
Makes the Fed's job even tougher to constrain inflation.
Wage gains is something that, complicates their mandate.
The labor market remains very tight, and wage pressures really haven't eased sufficiently.
It's definitely problematic for the soft landing.
The big question for all of us, looking at the economy, looking at the markets, will it have demonstration effects?
We don't know if there's a larger and more prolonged strike, exactly what it would do.
This is unprecedented.
Joining us now to discuss is TPW's Jay Pulaski, as well as Academy's Peter Cheer. Let's start with what to expect from rates going forward. I mean, I would have thought a couple days ago it's a perfect time to buy because they couldn't go any higher, and yet they continued to march higher. Jay, what do you think about rates? Is it a screaming buy?
Well, Matt, great to see you. I think the rate back up here really demonstrates the depth of belief in recession within the bond market. I mean, the way I'm viewing the last couple of days is that the good news is that the Fed is more in line with reality than at any point since COVID struck us back in March of 2020. I was on the program several weeks ago and suggested that the Fed was going to double its 2023 GDP forecast and raise 2024, and that's exactly what they've done. They took down unemployment, and basically they took recession off the table. And from a risk asset point of view, I think the opportunity is much more in equities than in bonds, because essentially what we've done is we've traded a recession call for 2 fewer rate cuts in 2024. And I think that's absolutely a great trade for risk assets. And as I see it, the Fed is now validating what the other cross-asset markets have been suggesting, namely that we're in a bond bear market, that the commodity bull market, commodities are up almost 8% over the past month, validating that, validating the rise in earnings revisions that have been supporting equities and will continue to support equities, and supporting the thesis that the credit market has been telling us, which is that everything is fine. So we're on a hunt for the return to stability, which is going to unlock the $1 trillion that went into the money market funds. And I think we've moved a lot closer to stability, believe it or not, after the last couple of days than we were a week ago.
Peter, don't we have to see at least another hike from the Federal Reserve? Because, you know, as Jonathan was pointing out earlier on surveillance, they have been saying for a long time they believe they're sufficiently restrictive, and yet the economy continues to grow, right? And yet the labor market is still very strong. And we could get more inflation coming out of, obviously, this strike, considering it's looking like it's going to go on a little bit longer. So aren't they going to need to raise rates more to really be restrictive?
I don't think they're actually going to need to do that. I think if you look at the last job report, it was perfect, right? We actually had labor force participation increase. So I think as the data keeps coming in, it is going to give them enough reasons not to do anything, which is what I think they're looking for. Up until recently, they've been looking for excuses to hike, not looking for excuses to do nothing. And I think the data is going to come in with that. I think people forget, too, just how good the consumer was and corporations were at locking in long-term yields. They borrowed longer term, even auto loans extended. Every part of the borrowing structure extended. So all these rate hikes, it's going to take a year, 2 years, 3 years for it really to start impacting most people. So they are better off leaving this on hold, letting real yields be high. And I think they're starting to get a message, too, a very strong message from small and mid-sized businesses. Enough is enough. Borrowing costs are getting hard for us. It is difficult for us to invest. And I think they're going to listen to that as well.
Peter, I want to drill down on something that you're implying here, that long and variable lags truly are long. A lot of people have made the argument, including Jan Hatzius from Goldman Sachs, that they aren't really, considering the incredible transparency, the fire hose of information flow that we get, and the fact that nobody has floating rate mortgages anymore. We're all fixed post-financial crisis. Do you really think these lags are still taking 6, 12, 18 months to come through?
Yeah, if anything, I think it takes longer, right? If you had a 3-year on average, you'd already be getting impacted. But people extended to 5 years. Corporations extended out to 8 to 10 years. So it's taking a lot of time for these higher costs to impact stuff. It's affecting some decisions, but it's not affecting current, capital bases. So I do think it's going to take much longer than people realize for this to impact. And the people who do have leverage loans, short-term debt that's rolling over, they are starting to feel the pain, and that's where the noise is going to come from. And they're going to say, enough is enough. Let's just hold off and see where this plays out.
Jay, what do you think about the extra dot in the plot? I mean, it was 12 Federal Reserve members who said we're going to need another hike. Are we going to need another hike? And also, does it matter? I've heard so many people say 25 basis points doesn't matter. Does it matter? Because we'll freak out on the day that they do it.
Well, that's natural, right, Matt? But yeah, to me, dot plots mean squat. In other words, the Fed's history of being right on the future is very poor. Guys like us that make a living getting the markets right would be out of business if we had the track record that the Fed has in predicting what the economy is going to do going forward. So I pay virtually no attention to the dot plot, never really have. And my focus, again, we're focused on the return to stability. We're focused here at TPW Advisory on the rate cutting cycle that is underway around the world, Brazil most recently just yesterday, as opposed to backward-looking rate hiking cycle. We're effectively done, whether or not, to answer your question, they raised 25 basis points or not. The point is that the Fed has validated the higher growth for longer. We're not going back to 2010, 2019, low growth, low inflation, etc. We're in a new environment with new industrial policy. Global growth is accelerating and inflecting upward, and that is what we need to see for equities. And I expect as we move into earnings season and we continue to validate 2024 double earnings growth for the S&P, equities are going to do just fine.
All right, everyone piles on the Fed, but I feel like, you know, they may be guiding us right now to a soft landing, which would be pretty admirable. Of course, there's still a massive threat. A few threats, but one I think that towers over the others, and that is the strike. Detroit's Big Three bracing for even more walkouts as a deal with the UAW remains elusive. A week into it, the union's president, Shawn Fain, set to announce the next steps at 10 a.m. Eastern. Bloomberg's Kayleigh Lyons joining us for more. So, Kayleigh, we'll hear the Facebook Live announcement in just about an hour, and then I guess in a couple of hours, that's the deadline that he's set.
Yeah, right. Set for progress in these talks with the big three automakers. And so we'll understand when Fain speaks less than an hour from now exactly how they plan to expand this strike, which to this point, a week into it, has remained relatively narrow in scope. We're just talking 13,000 workers who have walked out of 3 different facilities, one per automaker, a Ford plant in Michigan, a GM one in Missouri, and for Stellantis, one in Ohio, all that make profitable vehicles. And according to S&P Global Mobility, it's affecting output of these automakers in total by around 3,200 vehicles per day. The union, though, intentionally left room open to begin inflicting more pain if necessary, if they couldn't get closer to agreement with these car makers, and that's where we find ourselves now. Of course, the union continues to ask for a 36% wage increase over the course of a 4-year contract. All 3 automakers remain instead right around the 20% mark, so there's still a lot of daylight there, but that really isn't the only issue. Take Stellantis, for example. Union negotiators have said just some of their most important issues aren't being addressed, including the issue of job security, given the potential closing of a number of Stellantis facilities. There's also the wider question of the role of workers in the EV transition. That's one of the complicating factors here in Washington for President Biden, who has pushed that EV agenda, but also is trying to be the most pro-union president, he says, in history. He has still been on the side of the UAW. He says record contracts for automakers should mean record contracts for record profits, rather, for automakers should mean record contracts for auto workers. And yet we're still trying to figure out the contract details. And the longer this goes on, Matt, the more pain theoretically it could inflict on the economy. If we see this strike expand to all 150,000 UAW workers, for example, that could affect about 1/3 of the auto production here in the U.S. And remember, the auto sector is about 3% of GDP.
Yeah, it's, I think, a fascinating set of negotiations here. I mean, Dodge and Chrysler don't even have really any products announced for next year. They've shown us a Banshee concept, but nothing since then. And this could amount to a real wage price spiral if it gets out of control in the other direction. Kayleigh, how worried are people in Washington about this in terms of its effect on inflation or the slowdown of the economy?
Well, they're always worried, Matt, about inflation here in Washington. That said, at least on the left side of the political spectrum, including in the White House, there is a conversation happening ongoing about how much profit corporations are raking in and how that should be translated to workers. If you are pro-union, which many Democratic lawmakers are, they would like to see the UAW workers getting more money here. There's even some Republicans who are saying that, like J.D. Vance, the senator from Ohio, where you herald from, Matt, who have said that the UAW should be using its leverage here in order to potentially disrupt the EV transition. That said, elsewhere here in Washington at the Federal Reserve, of course, they are watching this very closely. When we talk about 150,000 workers, we are talking about a very small fraction of the American workforce. So theoretically, it wouldn't necessarily expand elsewhere, but it just speaks to this dynamic where employees are still feeling like they can ask for more money, and if they get it, that could refuel inflation.
Sure, if you're at a supplier or another automaker, even if you're not a union worker, you're going to look at them and say, I want that.
Yeah.
Also, we call it the great state of Ohio, Kayleigh, because 8 presidents call Ohio home. Of course. Thanks very much. Kayleigh Lyons there in Washington, D.C. Joining us now with a look at what's going on in the stock market ahead of the opening bell. Let's bring in Abigail Doolittle. Abby, what are you looking at?
Well, Matt, we are looking at a little bit of a relief pop for U.S. equity futures overall, with the S&P 500 right now up about 0.3% after a 3-day slide. Yesterday, the worst day for the S&P 500 on that hawkish Fed pause going back to March. But today you can see Amazon getting a nice boost, up 1.4%. This as they are saying that their Prime Video content will include ads starting next year. Activision Blizzard up nearly 2%. The deal with Microsoft is set to clear the final UK hurdle. And then ExxonMobil, just to broaden it out a little bit, we do have WTI crude still above $90 per barrel, up about 0.9%. And Morgan Stanley is maintaining their overweight on the shares. They've also raised their price target to $131. Not so bad. Again, a little bit of a bullish tilt for stocks this morning.
All right, Abby, thanks very much for that. Peter Cheer and Jay Pulaski are going to be rejoining us. I'm going to ask them what they think about the strike, as well as the shutdown. Time is running out on Capitol Hill.
Kevin McCarthy, on the other hand, doesn't play this right, could be subject to a sort of oust the speaker movement. And if that happens, then we have chaos. Then the shutdown could last a lot longer. And that's the nightmare scenario.
Government shutdown conversation still ahead. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Well, there are two scenarios, I think, right now that we're looking at. One is that the shutdown, lasts a little while, and then people come to the table and they resolve it because, there are probably 150 votes in the Republican Party that want to see the government stay open. Kevin McCarthy, on the other hand, doesn't play this right, could be subject to a sort of oust the speaker movement. And if that happens, then we have chaos. Then the shutdown could last a lot longer. And that's the nightmare scenario.
A growing risk of a U.S. government shutdown with just 9 days left to make a deal, splintering within the Republican Party, still causing massive problems. Speaker McCarthy's defense spending bill blocked on the House floor for a third time by a pair of ultra-conservatives.
Two people flipped, so I got to figure out how to fix that.
Did you know that they were going to flip before the vote?
No, that wasn't the impression they had given.
Representative Marjorie Taylor Greene, one of the GOP dissidents, suggesting McCarthy shouldn't have been surprised by her vote.
I've told him everything that I've told everybody else. I'm completely transparent in every conversation I have. We should have been passing our appropriation bills back in August.
Bloomberg's Anne-Marie Horder joins us now for more on, is it fair to call this an absolute mess?
It is a mess, and we are looking like
it's looking ever more likely that we will have a shutdown. And I think you could see the division there just from hearing Speaker McCarthy and Marjorie Taylor Greene. Marjorie Taylor Greene voted no on a rule yesterday. That rule would allow a debate on a defense bill, not even a vote for or against the bill, just the debate on the defense bill, because it took in and included Ukraine aid. This is what she said to Kayleigh Lyons yesterday. Kayleigh was up at the Hill. That is one part, Matt, of the GOP caucus. On the other hand, you have a congressman like Mr. Lawler. This is a New York congressman. He's from a Biden district, and he wants to see a vote next week on a continuing resolution. And if he doesn't see one, he says he may have a discharge position, which means he can work with Democrats, put one on the floor that would go over Speaker Kevin McCarthy's head. So this is what Kevin McCarthy is dealing with in terms of some of the individuals in his party and how far apart they are. And that gap, just at this moment, does not seem to be narrowing.
Does at some point McCarthy himself have to choose between being the speaker and getting absolutely nothing done, or governing and getting the boot?
Well, the thing is, if he governs and gets the boot, this will be even more chaos. Then who comes next in this position? What you're seeing is because he is dealing with very, very slim majority. And actually, that majority actually got even slimmer because there is a congressman who retired recently. You have some individuals who are out because of medical reasons as well. So this is going very difficult for Kevin McCarthy. And what you see him try to do is what we saw during the debt ceiling debacle, which is try to get some leverage from the hard right, put that on the floor, and see if that works when he's dealing with Schumer or the White House. But at this moment, he's not even able to get the hard right bill of a continuing resolution on the floor. If he does work with the Democrats, that means he's likely going to face a motion to vacate.
All right, Anne-Marie, thanks very much. Anne-Marie Hordern here in New York for UNGA, talking to us about the government shutdown as well, which I think it's safe to say is almost inevitable. Jay Pulaski and Peter Cheer are back with us. Peter, what's your take on the shutdown and how much it matters maybe relative to the UAW strike?
You know, for me, both are fairly back order type effects. If the shutdown lasts months or something, maybe it's a problem. If we get it in a week, I don't see a big deal. I think the auto worker strike is potentially a risk. Again, that will take time to see how it plays out. When I'm sitting here trying to look at the world, and what I want to figure out over the weekend and the coming weeks is, we're going to see some AI success stories. I really want to figure out, are companies going to be able to start demonstrating, hey, we've used AI and we've seen these great efficiencies? Because I think that would be much more important to the market than anything that's going on with either the government or right now even the auto strike. And I'm looking at the IPO market, right? We've started to see some enthusiasm for IPOs. It's been mixed results. Do we get one of those pops where all of a sudden you start seeing companies, you start seeing acquisitions, maybe like Cisco did yesterday, and really that drive the market? So in my scheme of things, that's what I'm looking for, and those other issues right now are kind of taking the back seat.
Jay, what do you think? I mean, a lot of economists have been telling me the UAW strike could be a real problem going forward, because if it goes on for a long time, that's going to mean big inflation for cars. And a slowdown in GDP. If they get a serious wage hike, then everybody else is going to want that too, and that drives up the pay.
Well, I think, first of all, Matt, DC is a clown show, right? And it has been for a long time, and I think markets are not going to be surprised by that. As far as the UAW, I expect it to be resolved reasonably quickly. There's plenty of money to go around. Profits in car makers have been significant over the last couple of years and likely to continue to be so. Here at TPW Advisory, we're focused on 4 signposts to the road to stability. And the first is continued disinflation in the U.S. and Europe. The second is a incipient global manufacturing recovery as we shift from inventory destocking to restocking. The third is continued upward revisions of earnings. And the fourth is policy traction in China. We're very focused on the opportunity set there. As long as China starts to gain traction, which we expect to be the case over the next quarter or two, we think the global economy is going to be fine. And look, we continue to be focused on opportunities outside the U.S., particularly in emerging markets and in commodities. And I think the U.S. is going to be fine, risk assets, because earnings are going to be fine. And that's all that really matters at the end of the day.
Peter, we just got 30 seconds here, but you know, there's a list of headwinds I don't even have to go through anymore because we all know them so well. Are you as bullish the global economy?
No, definitely not. I think China, to the extent they are going to see growth, it's going to be by them selling their products into emerging markets countries. So I think that's a risk for U.S. companies that sell into emerging markets. I do think India is really interesting. I think India, I'm trying to figure out the right way to play it. I expect really good growth out of there. And the one thing I'm worried about in terms of a commodity super cycle is India getting its story correct between space, between AI, between infrastructure, between onshoring or reshoring that's going on in India. If they take off, I think we could see a 2006 to 2008 type commodity super cycle. And it seems to me that sort of inflation is the U.S. Achilles heel. So that's something in my background as a real potential headwind, not today's problem, but maybe next year's.
All right, Peter, great to get some time with you. Peter Cheer there from Academy. Jay Pulaski, always good talking to you from TPW Advisors. Coming up, the morning calls, and then later, big tech falling victim to surging bond yields. Mona Mahajan of Edward Jones joins us at the opening bell, revealing her higher for longer playbook. That conversation still ahead. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is the countdown to the open. I'm Matt Miller in for Jonathan Farrow. After the big drop that we saw yesterday, off 1.6% on the S&P, the first time we dropped below 1.5% for over 101 days, we're looking at futures that are bouncing ahead of the open. Let's get to the morning calls right now. First up, Wells Fargo upgrading Charter to an overweight, expecting growth to reaccelerate due to new mobile and video initiatives. Next up, Canaccord downgrading Deere to a hold, citing slowing growth for large agricultural equipment and normalizing dealer inventories. And finally, Bernstein upgrading Wayfair to a market perform, pointing to improving revenue growth and management's positive messaging on margins. Coming up, big tech set to rebound as Treasury yields fall from multi-year highs. That conversation up next, as well as the open. Mona Mahajan of Edward Jones joins us. This is Bloomberg.
can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is the countdown to the open. I'm Matt Miller in for Jonathan Farrow. Moments away from the start of trading, we see futures up across the board after the big drop that we had in the live trade, in the cash trade yesterday, and after yields came back down a little bit, giving tech shares a little bit of room to breathe. There you hear the opening bell, and you can see it there on the New York Stock Exchange and here on the NASDAQ. Let's switch up the boards and take a look at some of the other asset classes that we pay attention to. The euro dollar, 106.48 right now. Not a lot of change there. The 10-year yield also little changed, but still at a relatively high level, 447.63. And NYMEX crude back up above $90 a barrel after having dropped below that benchmark price yesterday. 91.13 the level for West Texas Intermediate. Now, one stock to watch at the open this morning has got to be Activision. Microsoft is closing in on its $69 billion acquisition after passing a final regulatory hurdle in the UK. Microsoft executive Brad Smith saying, quote, "We're encouraged by this positive development in the Competitions and Markets Authority's review process." Ed Ludlow is here with more on this big deal. Ed?
It's astonishing because at the beginning of the summer, anyone you would talk to would say this deal wasn't going to happen. Now, look at Activision shares, $94.10, 90 cents away from the $95 per share offer that Microsoft made. This is a $69 billion deal. The compromise that Microsoft and Activision put on the table was to sell the cloud streaming gaming rights to Ubisoft, a French independent video games studio and publisher. And from the CMA's perspective, the Competition and Markets Authority, that is good enough to maintain a competitive market to their mind. It's interesting because basically Microsoft and Activision went to regulators, the CMA being the final hurdle, saying, the cloud market is a tiny nascent part of the video games industry. Why are you so hung up on this? But it's what they wanted to see. And Sarah Cardle, the CEO of the CMA, was on our programs earlier this morning saying, this is a lesson learned. Next time would have been easier if you guys had just done this compromise to begin with. There is a consultation period through October 6th, but right now, based on the spread and all of the reaction to this CMA provisional decision, this deal is going through, and it's a big one for the video games industry.
Yeah, a big one. People care about Call of Duty as well. Ed, thanks very much for that. Some breaking news right now on Ford. We see the shares also popping in the pre-market. Let's get over to Abigail Doolittle with the details. Abigail?
Yeah, indeed, Matt. We do have the shares of Ford popping higher right now, up about 2.5%. The best day since early June. And this on a Reuters headline that the UAW is to announce progress progress made with Ford and labor talks. And of course, at 10 a.m., the UAW is expected to ramp up this very particular strike that they're doing, surgical strike that they're doing. But now we do, of course, have this headline that UAW has announced progress made with Ford in labor talks. The shares are higher, up 2.3%. We also have a sympathy trade in the shares of GM. They are also higher, so we'll be waiting for more here. But the idea, quote unquote, real progress has been made by the UAW with Ford. So it will be interesting again to see what announcements could potentially follow this, and if it also is a good sign for both GM and Stellantis. One other stock that is moving this morning, of course, Matt, is Amazon. This after the company has said that they, similar to Disney Plus and Disney ESPN and Hulu and some of those other streaming services, along with Netflix, they are going to be running ads on Prime Video in key markets starting in 2024. And of course, right now, Prime on a yearly basis costs $139. The cost to not have those streaming ads, $299 a month, which is less than Disney. I believe it's also less than Netflix. But these major streaming services, they are trying to bring ads into the service and then get people to pay extra to not have to have that. And just to return quickly, Matt, because you are a car guy, Ford right now at session highs up 3.4%, the best day again, I believe, since early June. And on this Reuters headline that the UAW head saying that real progress has been made, and we also have now CNBC reporting on that in addition to Reuters.
Yeah, it's interesting. Usually the UAW gets along with Ford best. The workers like that the company is essentially family owned, or, you know, in a sense, and that Bill Ford gets personally involved in those negotiations. So typically they're friendlier. On the other hand, it hasn't looked like that over the past couple of weeks. We'll continue to follow these developments very closely. Abigail, thanks very much for that. Now, a big day for Apple. The new iPhone 15 going on sale in roughly 40 countries today. Dan Ives of Wedbush writing, quote, iPhone 15 pre-orders are still tracking much stronger than we and the street originally expected, and up roughly 10 to 12% from iPhone 14 based on our analysis. Katie Greifeld is here with the latest. Katie, did you get yours yet?
I haven't gotten mine yet, and apparently online reservations are hard to come by as well. But you take a look at shares this morning, up slightly as the iPhone 15 Pro and Pro Max models go on sale in this first wave. And Matt, there's at least two big tests here. The first one, of course, is what demand will look like for the new iPhone 15, and also can Apple fulfill that demand. Now, at least on the first point, there's plenty of early signs that indicate that people definitely want to buy this new phone. You take a look at new online orders for the highest end new models, and they won't arrive for customers at least until mid-November in several countries, rather. And while reservations for in-store pickups, they actually quickly sold out. So a lot of early indications of demand, and that's good news for Apple because there is a lot riding on this. These models will represent Apple's biggest sellers through the end of 2023 and are expected to make or break Apple's holiday season. Obviously very important for the iPhone maker. It's hoping to return to growth after a streak of quarterly sales decline, Matt.
All right, we'll be watching that. I saw lines outside the Apple store on Fifth Avenue driving in this morning already. Katie, thanks very much for that. Mega cap tech stocks flirting with one of their worst weeks of a pretty good year. Surging bond yields have kept pressure on some of the sector's biggest names. Mona Mahajan at Edward Jones weighing in, writing, quote, we expect some broadening in leadership as rates remain elevated and would look to complement growth in tech stocks with better valuation parts of the market. Cyclicals and over time, small caps may play some catch-up. I'm pleased to say Mona Mahajan joins us now with more. Mona, great to have you on the program. I didn't see the word value there. Certainly not, describing that group of stocks. It's almost become a dirty word in this market because it doesn't seem to ever win out. What's the story?
Yeah, thanks, Matt. Look, I think a lot of the sectors that were mentioned there are part of the value complex. So to broaden it out to value more broadly, I think probably would also include some of the defensive parts of the market like healthcare, staples, and utilities, which tend to outperform in periods of a recession. And clearly this economy has held up too well to pile into defensive parts of the market. So we want to be really particular in what we're looking at if we do expect a broadening of market participation. And this is really for the quarters ahead as we head towards 2024. That is really an environment where we see the Fed potentially pausing and, as they've indicated, maybe pivoting lower. We see inflation continuing to moderate, and we could get a rebound in earnings growth as well. So that's a better backdrop for a balanced portfolio. Now, we wouldn't want to wholesale get out of the AI tech story. We think that's in early phases of a secular bull market as well. But we certainly think, given what's happened this year particularly, some broadening of participation, especially if we reemerge from some sort of period of economic softness, does make a lot of sense. We want to make sure portfolios are balanced, diversified, and have exposure to those cyclical and potentially small caps as well.
What are the cyclicals? I mean, do you like the automakers right now? It seems like a tricky situation.
Yeah, I think we have some headwinds ahead of us that not only with the UAW strike, of course, we have a potential government shutdown. We have oil prices that remain elevated, walls of worry that the market will have to continue to climb. But markets have looked forward in the past. They will continue to do so. So within the cyclical complex, we think industrials make a lot of sense, especially as infrastructure will continue to be built out here in the U.S. and globally. A lot of manufacturing is coming onshore across the globe. And so I think that'll be a trend that continues to play out in the next 12 to 18 months. Certainly areas like financials, which have historically been more levered to a better economy, could look to a period of better performance, but probably not till 2024, back half of 2024. And energy is the other part of the cyclical story that's already shown, better performance even in this quarter. Part of that has already played out, but I think, those three sectors in cyclicals we would continue to watch carefully. Think about consumer discretionary as well as we move forward.
Yeah, I was wondering about that. I mean, restaurants, airlines, hotels, luxury. How do you view the U.S. consumer right now as we get reports from places like, Darden, that its customers are choosing less expensive wine, although those aren't probably the same customers buying stuff from Hermes and Gucci.
Yeah, look, it's interesting. The consumer has been the backbone of this economy. They've been extremely resilient thus far. But we are entering this period. We're at the end of the summer travel season, and consumers are faced with not only higher oil prices, now an interest rate environment that may be higher for longer. And of course, we know they've worked down some of those excess savings that were given to them in the post-pandemic period. And by the way, credit card levels are elevated and lending standards are tighter as well. So this is, probably some headwinds to consumption in the consumer in probably the 1 or 2 quarters ahead. We'd expect a bit of softening, not only in the consumer, but we're seeing early signs of labor market maybe cooling as well. So areas that had really held up well, will the next move be, better or some softening? We think probably some easing is likely. And so that's something to keep in mind, especially as we think about, earnings and growth in the months ahead.
What about rates? I mean, 4.5% on the 10-year, more than 5.1% on the 2-year. I mean, really across the curve, you're getting a decent return, so that even if you don't see capital appreciation, which seems likely to me, you're still getting a nice coupon.
Yeah, Matt, you summarized it well. Look, with yields towards the highs of this cycle, in fact, of course, there is some intrigue in the shorter duration part of the market. Cash and cash-like instruments are giving an opportunity that we haven't seen really in recent history. But there is some risk there. If you're in a CD and you have to reinvest in the months ahead, you might have some reinvestment risk. You have to reinvest at a lower rate. But also you can miss out some of the interesting opportunities that are forming. And to your point, the bond space in particular, especially if we look at a little bit of a longer duration investment grade bond area, that could be really compelling. Historically, forward bond returns have been determined by where the current yield is. And current yields, as we know, are probably towards a peak. And you're not only kind of locking in these better yields for longer, but you have that chance, to your point, of price appreciation. If over time, the Fed not only pauses, they pivot lower, you really have this nice window for extending duration ahead of that move, to your point, price appreciation and locking in yields. It's a nice combination that you might be getting in the months ahead.
Mona, stick with us. Mona Mahajan there from Edward Jones. We're continuing to see breaking news come across the ticker on Ford. People familiar now telling Bloomberg News that the UAW is making meaningful progress with Ford. And of course, we're set to get an announcement from the union president at 10 a.m. on Facebook Live. And then he set a deadline for 2 hours after that. Let's get back over to Kaylee Lines right now. She's in Washington, D.C. and has more for us on this developing story. Kaylee?
Well, Matt, you can see it moving the market already. Ford shares now up about 2.5%. If these gains hold, could be the best day for the stock going back to June on this news of progress being made with this one particular automaker. We will, of course, look for details from Sean Fain's live streamed event that is happening just about 20 minutes from now. But remember, there's still two other automakers at play here, GM and Stellantis, and we don't have news at this point of whether or not progress is being made on that front. So when we're thinking about the ways in which this strike could expand or not, which automaker could see more pain inflicted by the union. Ford shares, though, definitely benefiting from this news. Now, we did have a separate report also just moments ago from Reuters that the UAW was going to ask President Biden or invite him to come to the picket line. And this is really interesting, Matt, because, of course, as we've talked often about, President Biden has billed himself as the most pro-union president in history. He's come out on the side of the UAW workers, even though he says no one wants a strike. But also we have to consider that next Wednesday, on the evening of the second GOP primary debate, President Trump, former President Trump, is going to be counter-programming that debate by being in Detroit and addressing the UAW. So it'll be really interesting to see if we have the former president and current president, who right now are the front runners of each of their individual parties in the 2024 race, showing up at the picket line. But as for Ford in particular, right now up about 2.25%. We'll look for more details on that progress from Sean Fain just a short time from now, Matt.
All right, Kaylee Lyons, they are covering the developing strike story for us out of Washington, D.C., and obviously it's very closely related to the political story as well. So she's an excellent person to get updates from. Coming up, fresh economic data rolling in. We're breaking the latest U.S. PMIs after a little bit of a disappointment out of France and Europe. This is Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
I know one of the reasons you're here in Marrakesh and in Africa, because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on dinosaur era fossil deposits of oil, coal, and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
The committee left the additional rate hike this year in the dot plot. I think that may be a good thing to do as insurance to make sure that core inflation especially continues to come down. I think the risks are building that inflation could hang up at a higher level or even go higher based on the idea of a reacceleration in the U.S. economy.
That's former St. Louis Fed President Jim Bullard speaking yesterday with Mike McKee on the U.S. economy. Breaking PMIs crossing the terminal right now. Let's get over to our international economics and politics correspondent, who is actually sitting right next to me. There.
Yeah, not overseas, but we do have numbers both in the United States and overseas, and the U.S. is not Europe. We can say that. Global manufacturing on the S&P manufacturing index for the PMI, 48.9. That's up from 47.9. Still a little bit below the 50 break-even point. But services and the composite for the U.S. remain above 50. 50.2 for services, 50.1 for the composite. Those are down a tick, but they do show still continued growth in the U.S. And that is a completely different story, Matt, from what we see over in Europe. You take a look at France, Germany, the Eurozone, and the UK all reporting today those global, those S&P global PMIs. Look at all the 40s. There are no 50s there. And in Germany, rather, you see 39.8 for manufacturing. Germany, the only one of those countries at this point forecast to actually go into recession by economists surveyed by Bloomberg. But the UK very close to it. And of course, the Eurozone itself is struggling with manufacturing. You look at those numbers, and it is definitely not the U.S. We'll see what the Fed thinks of these numbers and what the Fed thinks of what the Fed did, because today we get a lot of Fed speak. The blackout lifts today. Lisa Cook is speaking. Mary Daly and Susan Collins are speaking. All this coming up after 10 a.m. this morning, and Neil Kashkari later this afternoon. So we will get some idea of whether the markets are reading the Fed right and what they decided the Fed is going to do after the decision on Wednesday.
All right, Mike, thanks very much. Michael McKee there, Bloomberg Television's international politics and economics editor. Mona Mahajan is back with us. And Mona, you know, what's your take on, I guess the PMIs here are pretty much in line with expectations. The French PMIs I saw disappointing, and Europe looks like it may be contracting. How does the economy look to you?
Yeah, you know, it's interesting when you look at the dichotomy between manufacturing and services. Of course, manufacturing had been in a downturn, and now we're starting to see a bit of stabilization, even a tick higher. And services, which had been driving, you know, the U.S. economy, looks like it's heading towards a peak. And so this idea of rolling downturns, or as some call rolling recession, could still be in play here. You know, parts of the economy that had originally really kind of gotten hit hard by the Fed rate hikes are starting to see signs of stabilization. You can maybe even put housing in that category, and services, which, you know, had kind of chugged along, may now start to stall a bit as we're heading towards these peak rates that finally, you know, may catch up with that lag impact that we've all been talking about. And so we do think that the U.S. economy could soften, but probably not, you know, heading towards any sort of technical recession, but a period of below trend growth. And even in the Fed projections, you know, the 1.5% for 2024 could imply a softer first half followed by a rebound in the back half of the year. And I think that to us seems like a credible backdrop.
In terms of next year, you know, so many people have been saying we're going to see double-digit earnings growth come back again. I guess you have to be in the soft landing camp to believe that. But if we do get sweet economic growth in the U.S., why do you think the Fed would cut rates twice? What's the catalyst?
Yeah, it's a great question. And, you know, look, I think with rates here, even at 5.25% to 5.5%, still highly restrictive. And if you think about inflation perhaps continuing to moderate, you know, even in line with their own projections, that brings the real rate, you know, the nominal rate minus inflation, even higher. Even if the Fed just, you know, keeps steady at this pace on pause, real rates, which do impact the economy and do add a bit of tightening, continue to move higher. Now, if they do believe that a neutral rate is closer to 2.5% to 3%, and if inflation continues to moderate, do they need to stay at such a restrictive level for an elevated period of time. And so I think over time, the way they would probably communicate it is they're going to start normalizing rates gradually back towards a neutral level. And so that could be where you get the signal of 1 to 2 rate cuts next year. We think that is a credible scenario. If the economy softens more than they expect, the original scenario of 3 to 4 cuts may be back on the table as well. But for now, I think a normalization out of this highly restrictive territory is probably the path of most credible for now.
All right, Mona, thanks very much for joining us. Mona Mahajan there from Edward Jones. Let's get some sector price action this morning. For that, we go to Bloomberg's Abigail Doolittle.
Yeah, Matt, very quickly, we are looking at a rebound rally for the S&P 500. So we have more sectors higher than not, led by energy. Interestingly enough, we have some of the rate-sensitive sectors on bottom, such as utilities and real estate and healthcare. Even though rates are lower, those dividends should look better. That's not the case. On the week, though, let's take a look at the week. The S&P 500 right now heading to a decline of 2.5%, the worst week since early March. Here are the two best sectors. Defense, so that's risk off, and then the two worst sectors, real estate and consumer discretionary. Rough week for stocks, third week down for the S&P 500 in a row, Matt.
All right, Abigail Doolittle, thanks very much. Coming up, the market-moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
This is Bloomberg's The Open. I'm Matt Miller in for John Farrow. Time now for the trading diary, what you need to be watching through the next week. UAW President Shawn Fain making an announcement on Facebook Live, this coming amid fresh reports of meaningful progress just in the last 30 minutes in the UAW's negotiations with Ford. That announcement on Facebook Live at the top of the hour will bring you all the headlines. Plus, more Fed speak from Mary Daly and Neil Kashkari. That's at 1 p.m. New York time this afternoon. We get U.S. GDP next Thursday, plus more Fed speak from Goolsbee, Barkin, and Chair Powell. And finally, the government shutdown deadline coming at midnight on September 30th. This is Bloomberg.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
How do you compare the pleasure of being Secretary of State, Senator, First Lady with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Brokers studio in New York City. It is Friday. We made it. Coming up, we're going to take a simulcast of UAW's Sean Faines. He has some Facebook Live comments coming up in just moments. When he does that, we will bring that to you. We're going to check in with Ed Curry, radio reporter for Bloomberg News. He's in Detroit to kind of get the latest there. Who's darkening our doors?
We have Anne-Marie Horder here.
Wow, that is big.
She is here in New York, luckily for us, to cover UNGA. But you've also got the government shutdown virtually guaranteed and the UAW strike that's pulling in President Biden, or at least attempting to.
I'll tell you what, Anne-Marie did nothing to help the traffic this week. I mean, it was as bad as ever. Cross town, impossible.
Today
today
was better.
Yeah, it's better. They're all kind of getting out of town here. So we'll bring all that up. But let's kick everything off, as we like to do, with Mr. John Tucker.
All right, as we wrap up the trading week, Matt and Paul, major stock averages all higher right now. After the 3-day decline, S&P 500 up 0.2%. Right now, you have 6 of the major industry groups higher. The best performing group, that belongs to energy. You had that data a little earlier, S&P PMIs out, just showing the biggest part of the economy, services barely expanding. Meantime, the economy can withstand higher rates for longer, at least according to Dan Morris at BNP Paribas.
Pre-global financial crisis, of course, this was quite normal, and I think the stock market did just fine, and the U.S. economy did just fine with rates at this level. So it's not so much the level of the rates that's the problem, it's the adjustment. We thought we had gone through that adjustment last year, and that was rather painful. We're getting a mini replay of that now.
It looks like Microsoft's cleared the final regulatory hurdle in its merger with Activision Blizzard. As yields dipped slightly from the highest since 2007, you have shares of mega-cap tech stocks rising. Apple, Amazon, Alphabet, Meta, Tesla, NVIDIA, all higher in the early going. S&P 500 right now up 9 points. That's up 0.2%. The Dow Jones Industrial Average 11 points higher. And right now the NASDAQ 100 up 66 points. That is up 0.5%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that as always. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker studio. We're also streaming live on that YouTube thing. So youtube.com, that's the intraweb, and just search Bloomberg Radio. There you go. So
if you're watching on YouTube Live, you'll see that this microphone doesn't go tall enough for me.
It's because they
I have to like hunch down.
I don't know. It's put a ticket in. That's all I can say. Put a ticket. They're not. It wasn't made for somebody who's 6'3" or 4, whatever it is.
So there's so much going on in Washington. Yep. And our star Washington reporter is here in New York.
I know.
For
How's that happen?
Anne-Marie Hordern joining us right now on, to me, the most interesting thing is that the UAW in this strike, which could go on, we're going to hear from Sean Fain in just a moment, has asked President Biden to come join them on the picket lines. And he is the self-proclaimed most pro-union president in the history of America. So if he's that pro-union, I guess he's there. Invitation accepted, right?
So this is what Reuters is reporting that Sean Fain and the UAW is going to send this invitation to President Biden. And to your point, I don't know how many times we've heard this from President Biden, that he wants to be, will always be the most pro-labor union president in American history. But Biden, of course, is trying to walk this line. I think he did have some strong language when he came out and spoke about the negotiations, putting his thumb on the scale for the labor union. But at the same time...
But leaving instantly and taking no Q&A.
Well, yeah, that sometimes also is part of the course. But at the same time, he doesn't want to see a prolonged strike, right? What does that mean for supply chains? What does that mean for these kind of communities? Look at the fact that now the former president is trying to also campaign off this. Now, while we know the UAW leadership does not like him, the rank and file
doesn't like Trump. Trump said he was going to go join the picket lines, and they said, you're the kind of billionaire that we are protesting against with this strike.
And there's a ton of history there when auto plants were coming out and saying maybe they'll set up a factory in Mexico. Trump said go somewhere else, and then even if it's not a union state, and then these guys are going to be begging for their jobs, and you could still keep your Detroit plans and just go back, and they'll have no choice. So there's a lot of friction there. But rank and file Republicans, according to all these strategists I talked to that do a lot of internal polling, you do see some rank and file members want to vote Republican. And a state like Michigan is crucially important for Democrats. But remember, Trump won it in 2016. He flipped it the first time since the late 1980s. Biden picked it back up in 2020. But it's why this makes this so important. And the other political part of this is, of course, for Biden, it's being the pro-most labor union president. How does that work with also being the climate president he wants to be?
Right.
Because the underlying tension of these negotiations is, of course, electrifying the grid, the EV cars that this administration is spending billions of dollars on.
All right, so Bloomberg's got a piece out here, Bloomberg News. United Auto Workers President Sean Fain is expected to announce progress at the bargaining table with Ford Motor Company, an indication the union may not expand its strike targeting the automakers, said two people familiar with the matter. So there's lots of moving pieces here just today with this strike, but it's in everybody's interest to get it done sooner. We also have the other issue of, is my government going to be working, in a couple of days? The rhetoric coming out of Washington, it just doesn't sound like they're making much progress, does it?
No, it is a little bit chaotic and almost very confusing at this point to figure out exactly how they get this done. The bottom line is Speaker McCarthy has a very slim majority. It recently got even slimmer because he lost a congressman who retired. He also has some individuals who are out for medical leave. So what he is trying to do is balance the hard right flank of his party against the centrists. And the issue is if he doesn't explore every option with the hard right, and he comes back and does a deal with the centrists that will probably need Democratic votes, then the hard right might actually want to have a motion to vacate and get rid of him from this top job. So he's trying to do this strategy like we saw with the debt ceiling, pass something on Republican lines, give him some leverage with the majority leader in the Senate, Chuck Schumer, a Democrat, of course, in the White House, and then if it comes back around, pass it down the middle. The issue is these Republicans on the far right are not concise in everything they want. It's all different provisions they want. on a number of issues. And I think yesterday was the biggest test because they yet again failed to vote on the rule to even start debate on the defense budget. Not to vote for the defense budget, but they wouldn't even put it on the floor to debate. And I think that shows just how chaotic and in disarray the Republican Party is. So
they don't want to fund
McCarthy
the military?
Well,
the Republicans don't want to fund the military?
Well, this is what I'm saying. When we say the Republicans, right, the issue is about potentially between 10 to 20 people at max. It's really just a handful. Yesterday, you had someone like Marjorie Taylor Greene, who actually is an acolyte for McCarthy. But she said because the defense funding had Ukraine attached to it, she refused to vote on the rule. This is what she told Kayleigh Lyons, who spoke to her yesterday. She refused to vote on the rule because of Ukraine aid. She said Ukraine aid needs to be stripped out and that should be dealt with differently.
But she doesn't believe in independence and freedom for Ukraine? Or is she pro-Russia?
No. What the issue you have right now regarding Ukraine in Washington, D.C. is the concerns that there's not enough oversight, the concern that too much money is going there when the American public is dealing with things like higher inflation.
Interesting. So I guess we're getting...
look, we are on TV.
Let's go to Sean Fain from the UAW. Here we go, via Facebook.
Victory for our union. Last night, 2,900 graduate workers at Northeastern University voted by an overwhelming 94% to form their union with the UAW. Congratulations first and foremost to these workers who have fought a multi-year effort against intense employer opposition to win their union. And also to Regional Director Brandon Mancia and lead organizer Josh Gilbert for their great work on this effort. In Region 1, 400 workers at Lear, the auto parts supplier, just joined Local 155. President William Verdier and Recording Secretary Sylvanus Thomas worked hard to help bring these workers into our union. From auto to higher ed and everywhere in between, our union is organizing, growing, and building our power. It's not just new organizing, it's on the picket line too. Our 1,400 UAW members at Blue Cross Blue Shield of Michigan just marked a week on strike. For years, the insurer has been outsourcing their work. Our UAW family at Blue Cross Blue Shield was once 5,000 strong. Today, it's shrunk down to just 1,400. And the workers that are left are stuck in a tiered system where it takes 22 years to get to top pay. Our members have said enough is enough, and they are being strongly supported by Secretary-Treasurer Margaret Mock, Region 1A Director LaShawn English, and Region 1D Director Steve Dawes. They are all working together to raise awareness and build public support for this critical fight. Just yesterday, members of Local 259 in Region 9A struck for one day after their employer, an Infiniti dealership on Long Island, refused to come to the bargaining table. Management was suddenly quick to move, and they have set new dates for the negotiations. And at ZF in Tuscaloosa, Alabama, in Region 8, nearly 200 members of Local 2083 who make front axles for Mercedes are on strike after voting down a contract that would have raised healthcare costs, maintained tiers, and left workers behind economically. They're being supported all out by Region Director Tim Smith, and they will win. Outside Philadelphia, our Local 644 members at Domedek are fighting for their fair share. The company's making a killing, but many workers don't make a living wage. Region 9 Director Dan Vicente, who comes out of Domedek, has their back. And some of you may know Dan was hospitalized after suffering sudden and severe complications from COVID. But the day he was discharged, he recorded a message of support for his Domedek family. Nothing can keep Dan or our union down. Not far away in Dayton, New Jersey, our Local 2326 members at West Rock Packaging are standing strong in their strike. When COVID was at its worst, they worked overtime to make the cardboard packaging that kept our economy going. They made the company and CEO David Sewell rich, but now he wants to slash their health care and we're not going to let it happen. In Newton, Iowa, our local 997 members at Thombert are facing down another employer that wants workers to go backwards. Thombert refused to start bargaining until 1 week before our contract expired. Sound familiar? Then the company insisted on cuts to accident and sickness benefits. Our workers aren't having it, and Region 4 Director Brandon Campbell is giving them the support that they need. In just over a week, the contract for 3,500 workers at Mack Truck in Pennsylvania, Maryland, and Florida is going to expire. Our union family at Mack are fighting back against attacks on their health care, a 6-year progression to top rate, frozen cost of living allowance, and tiers that have left new hires without retirement security. The stand-up strike movement is not just about the big three. Everywhere, UAW members in the working class are ready to stand up against corporate greed and stand up for our communities.
All right, that was the UAW President Shawn Fain talking about their continued strike here.
Just completely burying the lead, basically.
Yeah.
And that guy doesn't know hard news. This is not how you do it.
But he knows shirts. He's got
you got to
right
lead with a few headlines. You know, give us the contents, and later on, or I don't know what that was, like a summary there of all the strikes
every
in
local
America.
strike that's ever gone on.
Okay.
Bloomberg News crossing the tape. UAW to strike all U.S. Stellantis Mopar plants. So, and the UAW to strike GM parts plants in Pontiac and Flint. So they're stepping up. Looks like the UAW is stepping up some strikes as we thought at Ford and at GM and Stellantis. So the UAW is saying the strike against Ford will continue but won't be expanded. So let's get the latest on what this all means from the ground in Detroit. Ed Corey, radio reporter with Bloomberg News. So Ed, we've got the UAW expanding their strike. So Ed, expanding the strike, is this kind of in line with kind of the expectations out there in Detroit?
Well, yeah, I mean, there was some expectation that the original strike at 3 plants, Ford plant, a GM plant, a Stellantis plant, could be expanded. Then we started to get some Bloomberg News reports that Ford and the UAW have become closer to terms. So as you just mentioned, what we're hearing now is Ford is not going to be hit with an expansion of the strike, but it looks like Stellantis and General Motors will. So this is just part of the strategy that the union is trying for the first time ever this year. Not to pick one strike target, just to hit one company, or not all the automakers, just to hit specific plants, and it's hitting ones that are profitable. So it seems like this strategy is one that they're going to be continuing.
All right, Ed. So, I guess the issue here is just kind of next steps here. Any sense that
seems like it'll be worse for Mopar for sure than it will be for Facebook. Although I don't know like what cars they're going to produce anymore anyway, Ed. When they're done with the Challenger and the Charger this year, the only thing they have left is the Durango. The Chrysler 300 is well over, so the only thing they have left is the Pacifica. I guess Stellantis is only Ram and Jeep from now on.
Well, and that's okay. Jeep is certainly a moneymaker. SUVs have been profitable for all the big car makers, and Jeep is a star of the Stellantis show. So anything that could affect that, of course, the initial factory that was hit by the UAW action a week ago was a Jeep facility. So we could see more of that down the road. And the question is with Ford now, if Ford is not included in the expansion of this walkout, what are they going to do about the walkout that's in effect right now with the plant that makes, Broncos and Rangers? Are they going to, stop striking there? Or are they just going to not do any more actions against Ford? That remains to be seen, and that's going to be interesting.
Yeah, it's interesting. I mean, that you have the 3 negotiating separately. Is there any idea that they share their information at all, or is that not allowed?
Well, this is the union, many have speculated, has intended this. This is keeping the automakers on their toes. I mean, it's been said that, Ford or GM or Stellantis could, do some calculations and budget a strike, of week or a month or 7 weeks into their budget. But if you say, no, we're going to hit your most profitable plan, you know, your hot selling SUVs, we're going to hit that one. And then after that, who knows? Maybe we'll stop that. Maybe we'll pick another one. So now it's really hard to guess. And it really, you know, be difficult to share information when they're doing specific plans.
Yeah, it's a good strategy. Good strategy. All right, Ed, thanks so much for joining us. Ed Curry, radio reporter with Bloomberg News in Detroit, giving us the latest moves here from the United Auto Workers. This is Bloomberg. Let's get some company news right now. Steve Rappaport.
Paul, if you're just joining us, General Motors, Ford, and Stellantis are bracing for the next move from the United Auto Workers as the strike continues, or targeted strike at this point. Bloomberg's Craig Trudell has the latest.
They've talked about, by noon Friday, if they don't have substantial progress made in these negotiations, that they will sort of up the ante here. So I think, what we've heard as this, strike is now, a week in, is really that the sort of bid and ask here between the union and the companies remains pretty vast. And not a whole lot of budging on either side.
Thanks, Craig. Microsoft and Activision appear on the cusp of completing their merger. The $69 billion deal is set to clear its last regulatory hurdle after the UK's antitrust watchdog signaled it will accept concessions offered by Microsoft. More on that from Bloomberg's Ruth David.
Microsoft has agreed to give French video game publisher Ubisoft cloud streaming rights for Activision's very popular games. And that was one of the big issues that CMA was blocking this deal on, because their argument was that they wanted a market for consumers that was not tied up to any one company.
Thanks, Ruth. Shares of Microsoft are down, but Activision Blizzard stock is up. And a perk for Prime members will soon come with a cost. Amazon says it will include limited ads in its Prime Video service starting early next year. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg. Stay tuned for more Bloomberg Markets.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash, the major averages, they are all higher right now, slightly higher, we'll call it. The end of a busy trading week. We had some data this morning. Business activity in the U.S. stagnating in early September. That was driven by a further moderation of demand at the services operators. That's the biggest part of the economy, by the way. S&P Global Flash Composite Index registering the lowest level since early this year. As a result of that, Treasury yields, they are slightly lower. The 2-year down 4 basis points at 5.09%. The 10-year 4 basis points lower. That's at 444. That's helping boost stocks, especially some of the technology shares. Right now, the S&P 500, 10 points higher. That's up 0.2%. 43.39 on the index. Dow Jones Industrial Average, 7 points higher. The NASDAQ 100 up 73 points. That is up 0.5%. Some of the individual shares on the move of note, Scholastic shares. Right now, down 12%. The Children's Publishing Company reporting a larger than expected adjusted loss per share. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
Did I ever tell you my cool Scholastic fact?
I love that magazine you used to get in grammar school.
I was just about to say, my great-grandfather invented and published My Weekly Reader.
Really?
No kidding.
Yeah.
Oh, I didn't know that.
Big.
It's pretty cool, right?
That is.
I don't know
Do
if
you
they
have
still
like
read
some of the
them.
original copies anywhere?
No, I've never seen anything like that. I read them in school. My parents read them in school. I don't know if the kids still do.
I covered the stock
Yes,
for a
they
long
still
time.
get that.
Yeah. Anyway, very cool stuff. Let's get back to the strike, because we're getting red headlines across the Bloomberg terminal now from Sean Fain's Facebook Live presentation. He says the United Auto Workers Union is going to expand its strike, but only against General Motors and Stellantis. They're not going to expand their strike against Ford. Now, I'm not sure what's going to happen to Bronco production. I'm sure a lot of people want to know about that. So I'll find out and get back to you on it. But they are going to expand their strike against GM and Stellantis. We have Kevin Tynan standing by on the phone, Bloomberg Intelligence, U.S. Autos analyst. Wait, is he there? He's there.
He's there.
Okay. Good. He's on camera. He's not even
him?
on the phone. Did you hire him?
Probably.
Congratulations. He's very good. Kevin, what do you think about this? So it seems like they're getting along a little better with Bill Ford now. And historically, they do get along better with the Ford Motor Company because of the Ford family and because of Bill, really. With GM and Stellantis, they still have serious beef. How do you read it?
Yeah, I mean, using it as leverage, right? Saying by expanding for Stellantis and GM and holding the line on Ford probably motivates, the competitors to get in there and be a little bit more aggressive with their negotiating in terms of what they're willing to give. It's not over yet. There's still probably a ways to go, and things like this might mean the biggest issues or the easiest issues, the low-hanging fruit is handled, but it's probably going to be in the details before anything is really agreed to across the board.
Hey, Kevin, is there you've probably done, I'm sure you've done the analysis. When does this strike start to hurt them financially, the big three?
It's weeks, not days, obviously. And keep in mind, too, there was a buildup of inventory ahead. So there are units on the ground. And you could think of it of a little bit of a working capital shift from one quarter to the next, unless it gets very long. The last one was 40 days in 2019 against General Motors, and that's significant, right? So, and historically, even though inventory is above where it was a year ago, it's still very low historically. I think I calculated it out to start September was probably about 43 days of inventory for the industry as a whole, and typically 55 to 65 days is considered manageable. So it's below what's considered, a healthy level. And at the worst, the domestic automakers, they would have 80, 90 days supply in some months. So significantly off that, but not as bad as it was prior to the pandemic.
In terms of job security, I mean, we know that they're asking for pay rises, obviously. They also want a pension, which seems less likely, although I'd love to hear your take. A 4-day work week, which is like, there's no way in hell, right? But they want actual job security. So from GM, there's a ton of cars coming, new production. Mary Barra says they won't need fewer workers for electric vehicles. There's just a massive offering there. From Stellantis, not so much. I mean, they have a couple brands that seem like they're about to die out.
Yeah, look, and I think it's the line of sight is pretty clear, right? So the automakers have made a lot of money the past couple of years, not even just through the last contract, but probably over the last decade. And it's very easy for the union to point to that and say, we want our share of that. You've been very profitable due to the concessions we've given over the last couple of contracts, all the way through the bankruptcy period. And it's not going to be easy for the manufacturers to hide that, right? That you can see that money every day in every filing. But at the same time, the manufacturers can look at the unions and say, but look at our production, look at our sales. Volume is way down from the 2017 peak in this country. U.S. sales in 2017 were 17.5 million. We're running at a 15.4. So I think it's going to be the manufacturers pointing to that and telling the union, we can't give you a whole lot of job security. This market is smaller, and it's going to continue to be smaller. Transaction prices will be higher, margins will be better, the money will be there, but we can't guarantee capacity and headcount going forward. We need that flexibility. And then on pensions and healthcare, you know, the manufacturers have a very easy time of directing the eye of the union to, that's what we were bankrupt, remember, in 2009 and 2010, and that's the structure we had, right? So two of those three things are a little bit easier for the manufacturer to explain away. The money is not. So I think when all is said and done, the likelihood is that the manufacturers pay up, but they want that flexibility to adjust the cost structure going forward. And I think, you know, the pension and health care going back to the way it was prior to the bankruptcy period is just a non-starter. I don't even think that gets discussed in any seriousness.
So I didn't believe you, Kevin, a couple of years ago when you said the industry was going to go from a mode of 17.5 million production down to, you know, something materially less, like 15.5 or something like that. But once again, you were right. And that, do you think the union believes that?
Well, here's the thing, right, is that you have to look at least one other input, right? Everybody wants to talk about volume and the headline of 17.5 versus 15.4, but revenue per unit matters, right? So while production and sales are down, average transaction price is at a record, right? Yep. We're heading to $50,000. So when you multiply out just back of the envelope, the revenue pool is actually larger. So, you know, you have to understand that not every unit is the same as every other unit. You know, a $20,000 Toyota Corolla is not a $65,000 F-150. And this industry is moving towards the latter, to say, we just want to sell as many $65,000 things as we can. We're willing to give up the bottom of that market. It means our volume goes away, but really the revenue pool and the revenue contribution and the profit contribution and your margins are just way better. And I think that's what this industry becomes going forward.
By the way, on that note, originally I was planning on talking with you about the Jeep Grand Wagoneer Obsidian Series 3 that I'm driving right now, you know, before this hard news crashed the party. But that is an extremely expensive vehicle. It's the biggest vehicle Jeep has ever made. The one I'm driving is $114,000, $115,000 in this trim. And though I love the new Hurricane 510, the inline six, it's amazing. 510 horsepower, 500 pound-feet of torque. For the same price, you can get a Range Rover or a BMW X7, the M60 version, or a Cadillac Escalade, the ultra super luxury platinum version. Like, are they selling these $113,000, $114,000 Jeeps?
Yeah, I mean, and look, the average on Grand Wagoneer, I just looked it up, is 105,000 is the average, you know, sales weighted. You know, but that's right there with Expedition. It's there with Suburban. That's what, you know, those have become the profit centers because you're sharing platform and components with pickup trucks. And now you're just adding content that's pure profit. So, you know, that's kind of my point, is that, look, if you sell one of those, how many, you know, Dodge Darts did you have to sell to get anywhere near that? And you probably lost money on every Dodge Dart, which is why it doesn't exist anymore. You know, so the old world.
They got the Hornet coming out.
Yeah, well, the old world would be like run production on Hornet all day long and then figure out how to sell it. And it's like the new model is going to be, hey, if we can sell 1 or 2 Grand Wagoneers, we can cut production of Hornet, which is why I say in this contract negotiation, the manufacturers need to protect that flexibility going forward, saying this is going to be a smaller market because we're selling more expensive things.
I think if I were an investor, I'd be like, I like this auto industry better than the old auto industry.
Yeah, for sure.
This industry is more profitable. And that's where Kevin has been telling us for years. That's where it's going.
But if you're a UAW worker, you would not feel that way.
No, absolute opposite. Kevin Tynan, thanks so much for joining us. Kevin is our lead auto analyst for Bloomberg Intelligence. He's based down there in Princeton. We didn't get to what he's driving, but like you, he gets to test drive all these cars, and he's always got something fun. Right now, let's head down to Washington, D.C. Amy Morris has got world and national news for us.
All right, thank you, Paula and Matt. And as you've been discussing, the United Auto Workers Union is ready to expand its strike against at least two of the big three automakers. UAW President Shawn Fain.
This expansion will also take our fight nationwide. We will be everywhere from California to Massachusetts, from Oregon to Florida. And we will keep going, keep organizing, and keep expanding the stand-up strike as necessary.
Now, Fain says they've made progress with talks at Ford, and they're not done, but that's why they're not expanding the strike against Ford. Fain gave the companies a deadline of noon today to show progress in talks. Senator Robert Menendez from New Jersey has been indicted by federal prosecutors over bribery offenses in connection with his relationship with three businessmen. Prosecutors say a search of his home turned up $100,000 in gold bars and $480,000 in hidden cash. The indictment, which includes Menendez and his wife, will be unsealed at 11 o'clock this morning. That's a little less than a half an hour from now. And we are days away now from a government shutdown. Negotiations are at a standstill. House Speaker Kevin McCarthy sent members home for the weekend. Bloomberg's Ed Baxter has more on that story.
McCarthy's efforts to get a government funding bill have blown up as he got ambushed by two ultra-conservatives, Eli Crane and once loyal supporter Marjorie Taylor Greene.
I've been very clear about take the Ukraine money out of the defense bill and put it in a separate funding bill so that members like me can vote no.
And others can vote yes if they want. McCarthy says still time.
I know it's not pretty, but this country's too great to quit on.
9 days with 3 off now, and the Senate also would need to do something. I'm Ed Baxter, Bloomberg Radio.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. You have big tech leading the gains after bearing the brunt of the recent sell-off. Treasury 10-year yields dropping after briefly topping 4.5% for the first time since 2007. So that's helping these technology shares today. Apple rising, the latest iPhones and watches going on sale. You just have to go over to Fifth Avenue and see the long lines outside the Apple store today. Ford climbing as the UAW expected to announce progress at the bargaining table with the company. Has been a bruising week for investors who've been grappling with the idea of higher for longer interest rates. Nadia Lovell at UBS doesn't see much movement for stocks going forward.
We have a fairly balanced view on the market from this point. We think that the soft landing is largely priced in, and so we're not calling for much upside to the market from here. Our year-end price target for the S&P 500 is 4,500, and so we're seeing a range-bound market from here.
Industry data today suggesting U.S. business activity stalled this month. The S&P Global Flash Index, we got that this morning, that covers manufacturing and services, dipping to the lowest level of the year. S&P 500, 17 points higher. That's at 0.4%. We're at 43.47 on the index. The Dow Jones Industrial Average up 16 points at 34,085. The NASDAQ 100, 122 points higher. That's up 0.8%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. Let's get right to our next guest here. Gitu Sharma, founder and investment manager at Alpha's Future LLC, joins us. Gitu, thanks so much for joining us here. I'd love to get just start kind of 30,000 foot level. Kind of how do you guys view this market right here, right now? A lot of, I guess, cross currents for investors out there.
Hi there. Yeah, I agree with you. The market's been a bit volatile lately. August, September, we're seeing a bit of weakness. And I think it's really this Fed narrative of higher for longer that is moving the markets and making it more choppy. I think the markets were, given the strong rally we've had this year, the markets were really hoping for the Fed announcing that, they've had a victory on inflation. We're looking at inflation at 3%, 3.5% at core PCE, and that the Fed would be a bit more dovish, talk about end to the rate hike cycle. But instead of that, we saw the Fed actually be more hawkish, and they talked up the economy. They raised their forecast for next year, both on the economic GDP data as well as unemployment rate being lower than what they had earlier projected in June. And they also talked about rates staying higher for longer. And I think the market did not like that. And we saw a huge sell-off yesterday. We are looking at a little bit of recovery today, but I think that's partly driven by just the sharp sell-off we've already had. And also we saw some data that seemed to imply that maybe the economy is slowing down. So there's some relief from that as well.
Sorry, what's your take, Gitu, on the consumer? I mean, I would imagine it's key, and we're hearing about so many concerns. Their savings may be depleted. Delinquencies on credit cards and auto loans are rising. This UAW strike is likely to either push up prices or push up wages, or both. How do you think the U.S. consumer is holding out?
I think it is really impressive how well the U.S. consumer has held up so far. And as long as we're continuing to see wage increases, I think the consumer is likely to continue to spend, because it is a big boost to their earning potential, especially the marginal consumer, the marginal spender. And we are still seeing pressure on wages. We are looking at this auto strike, which implies we're likely to see more wage hikes, and that could influence the wider manufacturing sector beyond autos, depending on what kind of contract they're able to negotiate. The U.S. consumer, I think, yes, we are seeing an increase in delinquencies, and they are seeing pressure on on their savings and on in their wallet. But I think this is kind of what the Fed is trying to engineer, a slowdown in the economy, a slowdown in spending. But at the same time, with real rates higher now, actually the consumers are able to get something out of their savings as well. They can get a little bit of income. So some of these things are, there's this trade-off, and we're not yet seeing a big drop in consumer spending. You just earlier talked about the long lines at Apple Store for the iPhone 15. That's not a sign of, a consumer that's weak.
Exactly. So, Gitu, I believe my colleague here, Matt Miller, was long those Magnificent 7 stocks this year. Unfortunately, I was not. So, do you recommend I chase some of those tech names, or should I try to find some sectors that maybe haven't participated in? And if so, which ones do you like there?
Yeah, so we are talking about a more balanced approach to investing. I think there is definitely a benefit of being in tech, given the mega trend around it, the AI of everything, and the tech playing a key role in some of the global issues like climate change and the transition to a more green economy. But at the same time, I think it's more what we're recommending to our clients is to think about valuations as well, given how much they've run up and how much growth is already priced in. So we are favoring tech stocks, even in the large cap, where we can still get some growth at a reasonable price relative to others in the market, whereas avoid the ones where valuations are pretty high, trading at 20, 30 times sales. I think that seems very expensive to us, and there is a risk of downside there versus further upside. I think on the other hand, you're absolutely right about sectors that have actually not participated in this year's rally.